Weaker. The pound, 121 is where we trade, down 0.3%. Consumer confidence and retail sales both telling a weak story about the UK consumer, and that taking its toll on the currency. And this is the US 10-year yield. The whole curve really in focus yesterday, as we heard from Jerome Powell. A lot of volatility in there, and a little bit of steepening, as Mark was referencing. Some of the action in the curve not looking quite the same as the long end higher rates story that we've seen of late, and looking a little bit different to that. But 4.93 is where we trade. We are seeing buying of treasuries and those yields coming down just a little just now. This is the futures picture for European stocks then. DAX futures, FTSE and CAC futures all looking negative. We overlay on top of some of the concerns around geopolitics, higher commodity prices recently, even if not overnight. We add on to that some of the earnings stories. The likes of L'Oreal perhaps could weigh on Paris. I mentioned commodities because not all the commodities are moving in an upward direction. Or we see Brent, though, is, and that can be crucial for the London market, of course, and WTI. So both of those move higher, and natural gas. It's dropped off here, but interestingly enough, iron ore prices moving lower today. And so we keep that in mind as we look at basic resource stocks in the UK as well. So as European equity markets open up then, we see the FTSE 100 is lower by 0.4%. The Spanish IBEX down by 0.9%. The French CAC 40 does indeed open firmly in the red, down by just over 1%. We'll see, we'll dig into the detail and see how much of that is an earnings story and how much is the broader macro themes. The pound then, we've talked about that is weaker, and that, as Mark was saying, giving a little room for the dollar to gain this morning, although as he was expressing it, given how much we've seen a move higher in yields over recent weeks, kind of surprising to some people that we haven't seen the dollar reflecting that a little more. So the dollar is stronger this morning, but not by much. The pound taking much of the other side of that trade. And here is the buying of sovereign bonds that we're seeing today, and some of those yields coming lower in reaction to recent market moves. Let's talk about sectors then, and what we have here. The earnings stories, as I say, could be a feature. We could see basic resources responding to the weakness in the iron ore price. We could see energy names on the move as a result of what's going on oil. I'm sure the sector's picture is coming shortly, and that'll tell us something. There we are. Energy stocks then going higher. We do see oil prices continue to rise, so that makes a lot of sense, of course. Basic resources, one of the weakest ones I can see on here, down by 1.6%. The iron ore price was substantially weaker through the Asia session, so no doubt that has something to say about it there. Travel and leisure is weak. This has been a sector that's been really in focus this week. We heard from United Airlines over in the US about what the higher oil price and what the cancellation of flights to parts of the Middle East, certainly to Israel, is going to do to the sector. So that's in focus too. So broadly speaking, a negative picture across European stocks. The CAC 40 down by 1.1%. Sam Unstead joins us from the Markets Today blog once again. And we add to some of these negative headwinds then, some of the data out of the UK, Sam, which has been weak. Retail sales, consumer confidence. I mean, some of that consumer confidence data looking like the start of the pandemic, looking like the first lockdown, which seems quite extreme given where we are right now.
Yeah, and actually the decline also similar to Brexit, in 2016. So, yeah, a very significant decline. I think it's worth remembering with this consumer confidence data, it's actually been in negative territory for quite some time now. The drop that we've seen this month, there could be a few reasons for this, but it feels as if some of these pressures that households are facing on their budgets, as mortgages continue to come through, really seems to be weighing now.
Okay, so that's the weakness in the data and influencing consumer confidence, as you described. Where does it leave us on the Bank of England then? Where is the Bank of England conversation right now? We've had an important lot of data out this week, but not all of it, because we get unemployment rates next week.
Yeah, that's right. Although I think at the moment, certainly in terms of the November meeting, I don't think there's really any change. So certainly traders are still very much that the bank will stay on pause. I think where the narrative has now shifted to is that higher for longer question, and how long are they going to stay at this level for, and when are the cuts going to come? Because that is where the moves have happened in trader bets. It is pushing out when cuts are going to appear.
And interesting to hear from Andrew Bailey this morning. He was saying that inflation figures, they were not a big surprise, and I think maybe that is in keeping with a lot in the market, a lot of the views in the market. But he was also saying that pay growth is still too strong for the Bank of England target, and he's been somebody who's talked about pay growth, watches pay growth quite a lot, and that hasn't really come down in the way that you might expect. What is he signalling when he says things like that?
Yeah, that's true, but I think there's an interesting sort of thing to note with the Bank of England and with Bailey in particular, that they have also been questioning the quality of that data, the official data, and mentioning a few times the REC KPMG report over the last few months, and other reports that we've had out, and I've mentioned on this show a few times as well, recruitment companies, very weak reports there, and pay growth slowing down. So it may well be that picture has become a little muddied, but still at the moment, certainly there's no feeling that there's going to be any change to a pause in November.
What are you taking away from earnings season so far then, Sam? And I ask this thinking about the broader European story, but we've got L'Oreal down by 3.4% today on the back of their numbers. We've had disappointment around some of the luxury names in Paris, and then here in London, we're responding today to a weaker iron ore price. That's all to do with the Chinese property sector, of course, energy stocks on the back foot as a result of that. How are you thinking about some of the clues we're getting, I suppose, from the earnings stories?
Yeah, I think so. Yesterday in particular, we had quite a bumper set of earnings, and actually there's kind of something for everyone to take from it. Again, there's a very mixed picture, particularly when it comes to consumers. So, for example, we had Nestle out, the trend there of them not being able to push through price increases so much and volumes going down for food sales is still the case. But then people aren't giving up their Netflix subscriptions. Netflix is adding subscribers everywhere. So it seems like we're in this transition period where people are deciding what they do want to spend money on, what they don't, as household budgets get tighter and tighter.
Yeah, and even within the tech sector, I thought it was interesting that in the same week we can tell a really negative story around ASML and a positive one around TSMC, telling us different things about where we've got to perhaps in that sector. Thanks so much, Sam. Sam Onstead from our Markets Today blog. You can find more from the blog team. Go to the front page of the Bloomberg UK website. You can click through to the blog from there, or you can type TLIV Go onto the Bloomberg terminal. Here's what we're watching out for today. European Commission President Ursula von der Leyen and European Council President Charles Michel will both be meeting with President Joe Biden in DC for a joint summit for the first time in 2 years. A lot of the geopolitics will no doubt be talked about, although they are supposed to be discussing trade between them and steel, very much part of that conversation. At 1:30 p.m. UK time, we get Canada retail sales. This as inflation in the country unexpectedly slowed, leaving room for the central bank to hold interest rates steady next week. Half an hour later, the Fed's Patrick Harker speaks in Philadelphia about the U.S. economic outlook. And finally, American Express reports third quarter earnings. Bloomberg Intelligence sees loan loss provisions they're expected to be 51% higher from a year ago, with delinquency rates presenting a possible challenge to profitability for U.S. card issuers into 2024. We will see how much of a theme the weakening of the U.S. consumer then is around that American Express story, all the resilience of it. We will bring you an update on all of the market news and plenty of geopolitics shortly. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything. The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose side.
Bloomberg. Context changes everything.
This is Markets Today. Just coming up to 10 minutes into the European equity trading session, a negative picture across European stocks. Certainly over in Paris, we see markets down by 1.3%, on the DAX down by 1.2%. European equities extending their drop to a 7-month low. Investors remaining on edge, of course, given what we are seeing in geopolitics. But let's focus in on some of the individual stock movers. Joe Easton has a briefing for us on some of the stocks on the move. Joe.
So lots of movement in the luxury and consumer goods space. Some of that weakness that you mentioned in France coming from L'Oreal, down almost 3% at the moment amid softness in some of their high-end brands and some of the brands that they do for other companies like Ralph Lauren, seeing a decline in some of those fragrances sales at the moment. The other big one we had in stocks to watch is EssilorLuxottica. Now they reported some weakness in their sunglasses business, so Ray-Bans, Oakleys, that kind of thing. But the bit that's saving it from a bigger drop is the prescription glasses business. Seems to be holding up better, given it's more of a staple good. Then there's a couple of Italian stocks in the luxury space. Bruno Cucinelli doing well, up 3.7%. That's cashmere sweaters, reporting some strong numbers this morning. But Salvatore Ferragamo, this is more in the shoe market. That is looking pretty weak, according to their trading update. And they are trying to do a bit of a turnaround in that business. So there's worries that that could potentially slow that down. Then speaking of sales in the UK, we've got Next. Now this one dipping off those weak numbers from September. The UK retail sales down almost 1% when you strip out the fuel costs in the last month. And we're also seeing declines in ASOS. That was one of the stocks that was halted an hour early yesterday. So potentially a bit more volume coming back in, but both of those declining following that UK data. A big dropper, meanwhile, is in bottle makers. We don't do bottle makers very often, but we have got Veralia. Now, this is listed in France and a couple of other exchanges as well, down almost 13% following a sales update. So that one looking very weak today. And I brought in BAE Systems following the US President's speech last night around both the wars that are ongoing. That one edging higher, but we have seen, obviously, gains in a lot of the defence shares for obvious reasons over the past couple of weeks. Then on the final board, we've got a bit of a mix. So Sika, a massive cement company, one of the world's biggest cement makers, reporting strong sales, potentially indicating strength in the construction sector more broadly, but a chemicals firm that is dropping. This is the fertilizer firm Yara over in Norway, down almost 5%. Again, earnings related, getting a slew of earnings from chemicals over the next few weeks. And we also had the auto numbers out of Europe up 11%, but we're not seeing gain in many of those stocks. Volkswagen actually declining, potentially with that broader market decline that we're seeing. And also, finally, I'm going to go back to bottles, two bottle stocks, but Tomra, they actually make bottle recycling machinery, very niche, but again, a big mover, down 15%. Not sure what's that saying about the broader recycling market, but getting hit hard. That's Tomra, down 14%.
OK, bottle businesses, the unexpected theme of stocks on the move this morning. Joe, thank you very much for that. Joe Easton from our equities team. Let's focus in on the US economy and then broaden our conversation around global growth. The Fed Chair Jerome Powell has suggested the US Central Bank is inclined to hold interest rates steady again at its next meeting. But with the economy remaining resilient, he also left open the possibility of a future hike.
There's a lot of uncertainty around lags, and one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is? Long-run potential growth is not something that moves around a lot over time, but I would, my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
Let's talk about the US, the UK, the global growth picture. Melanie Baker joins us, senior economist at Royal London Asset Management. Melanie, nice to have you on set with me this morning. We heard Jerome Powell there talking about lags, and I was just thinking about the data we got yesterday on the UK. Claims coming in at their lowest since January, so still strength in the US labour market, but at the same time, existing home sales coming in at their lowest since 2010. And I feel like that paints a picture of an economy in transition, doesn't it? Where the effects are sticking to the housing market, but not yet permeating throughout the whole economy. And where do we stand on that sort of lag story right now?
Yeah, and I think that's absolutely fair. And especially in the US, you've got different parts of the US economy doing different things. There's certain parts of the US economy, the very interest rate sensitive parts, have absolutely been hit earlier and harder. And especially you can see that in the sort of housing sector. That's been clear for a while in the US. What we haven't really seen, we've seen some slowing in the labour market, but it's still so resilient. And if you look at the kind of latest quarterly nowcast from the likes of the Atlanta Fed, above 5% quarter-on-quarter annualized inflation for Q3, there's still quite a lot of robustness in the US economy. It hasn't spread broadly.
Yes. And what's the next move in the US economy then, Melanie? Because at the same time as many people have been waiting and waiting and waiting for this recession that has been so talked about but doesn't come, at the same time, some of our colleagues are starting to think, actually, maybe we are going to be looking at a maybe short-lived, but an upturn, actually, for the US economy before anything more negative.
Yeah, I mean, that's absolutely possible when you've got strong pay growth and you've still relatively robust pay growth in the US and you've got a trend of somewhat lower inflation. Yes, that supports real incomes, labour market remains robust, etc. But I'm sticking to the view that we will get something of a mild recession in the US as lags in monetary policy start to pick up a bit more. We have got tighter bank lending conditions, we've got some tightness in financial conditions now feeding through. It's just taking more time than expected.
What's happening with the UK right now? Well, we've had two pieces of data this morning that look quite negative, don't they? The consumer confidence data and the retail sales picture. I mean, on consumer confidence, it looks like the start of lockdown 2020, which seems like a bit of an extreme comparison. It's not the full extent of the drop we saw during that lockdown at all, but it's certain. But in terms of the start of it, it looks a bit like that, and also around the Brexit vote where there was a lot of uncertainty around the economy. Why are we seeing those kind of parallels in the data right now? What explains that weakness?
That's quite interesting. And we kind of start weak already, importantly, for UK consumer confidence, and we've got a bit weaker on today's data. I mean, I still think cost of living pressures are generally weighing. I think people are probably watching petrol prices at the pump. They're worried about those. They're seeing the headlines on the geopolitics side, and we have started seeing deterioration of the labour market as well. And that's going to be really important. If people start worrying about their jobs, you'd expect that to start feeding through into consumer confidence as well. And maybe that's the bit might be starting to turn a bit more in the UK too.
Yeah, are we starting to see that more in the UK? I wonder where the cracks in the labour market are more evident?
Yeah, compared to the US, it's a much more consistent, sluggish, slower picture, I think, in the UK. And in terms of the labour market, we have seen a sort of less benign picture now starting to emerge. So we are seeing signs of lower employment in the very timely payrolls data, for example. Unfortunately, we haven't got the full set of labour market data yet this month for the UK. We'll get more of that next week. But at the moment, with vacancies coming off, we've had redundancy rates rising a bit. It's all starting to deteriorate.
Right, and so that should put downward pressure on wages, should it? Because the Bank of England is still waiting for that wages component to come into line with their expectations. And at the moment, it seems still elevated.
Yeah, absolutely right. It makes life very difficult for a central bank. Wage growth is still uncomfortably strong, I think, in the UK. If we do start seeing further deterioration in the labour market, yes, that can then give the central bank more confidence that we're going to see lower pay growth, but we're not quite there yet. We're starting to see a turn lower in the labour market, if you like. And as you say, pay growth is still too strong.
And what's your view, Melanie, on oil prices and how they feed into the risks for the economy? Because on the one hand, higher oil price, mechanically might create more inflation. But given the cost of living crisis we're already in many places, a lot of people say actually it might act more like a tax. It might actually reduce growth rather than have a lasting upward impact on inflation. How do you think all of those dynamics would play out?
Yeah, it's really interesting at the moment. I think, so in terms of the short term, absolutely it will push inflation up. And we've already seen some of that with higher oil prices. But yes, it should be a dampener on growth, particularly in the European economies. So yes, in terms of the sort of medium-term impact, I'd expect that to be lower on inflation. The complication is we're in a high inflation environment in Europe. The worry is that if you get big increases in petrol prices at the pump, that feeds through into inflation expectations, and it then doesn't have that same dampening effect. It just makes it a little more difficult, I think, for central banks to completely ignore, if you like, the higher oil prices at the moment.
And then the ECB, we should mention that. Their next meeting looms large, and I feel like we haven't talked about it all that much. I suppose the expectation is they're on hold, and what else do we need to know, Melanie?
No, absolutely. I mean, they've been reasonably clear, I think, in their signalling it from last meeting, that they thought this might probably be the peak in rates. And if you look at how the data's been coming out in the euro area, we had a downside inflation surprise. Again, quite soggy, some quite soggy economic activity data. It doesn't look like there's anything that's going to kind of budge that on hold view. I'd be watching out for something more on QT, on the PEP programme. It sounds like that's going to be a topic of discussion. We might hear from Lagarde on that in the press conference.
Okay, Melanie, thanks so much. Thanks for joining us this Friday. Melanie Baker, Senior Economist at Royal London Asset Management. Coming up on the programme, we'll get back to the earnings stories, and one to note today, L'Oreal falling after the cosmetics giant posts a surprise slump in North Asia's sales. We discuss the outlook for the European luxury sector next. This is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Markets Today, 8:23 here in London, so 23 minutes into our European trading day for this Friday, and European stocks are in negative territory, down by more than 1% on many of the major markets. Only the FTSE 100 with the energy resilience performing any better, but most sectors in negative territory this morning. Let's go to the source of some of that weakness. L'Oreal has dropped at the open after North Asia sales unexpectedly fell in the third quarter. Analysts have been predicting a jump in sales of more than 14%. It comes as the cosmetics maker grappled with a challenging travel retail market and a wider downturn in the luxury sector. Let's talk to our consumer reporter, Deirdre Hipwell, who's been getting into all of the detail of this report. Deirdre, very nice to have you with us. So let's focus on what we've got here from L'Oreal. What is it that we're hearing in terms of the earnings? What have we seen that's dented the Chinese shopper story for L'Oreal?
I think it's really been the weakness in Korea and Hainan, which is a duty-free zone for Chinese shoppers. They just haven't returned as people expected they would, and that means that L'Oreal's travel retail section has taken a real dent. And more widely, I think if you just look at what's happening with the Chinese traveller, they just haven't returned to travel in quite the same way everyone thought would happen after the pandemic. They've only recently restarted tour groups to Europe, and we're just not seeing as many Chinese tourists, and obviously that has an impact for L'Oreal.
Yeah, and so L'Oreal, that's the story around Asia, but also a focus on North America, and we've talked about that in the context of some of the other luxury names. What's the L'Oreal story there?
Interestingly, they were quite strong in North America, and in part that's because they're quite diversified, so they have a mass market brand which consumers who may have been more cost conscious have been able to trade down to. So, for example, Maybelline New York. So they've actually kind of bucked the trend a bit in North America. But in general, North America is really concerning luxury watches at the moment, because last week LVMH, obviously a juggernaut of the industry, surprised a bit on the weakness in their wine and spirits division. And looking ahead to next week, we've got Hermes and Kering, and I think we'll be watching to see what's happened with the North American consumer there.
Yeah, so what is this telling us about the luxury sector and where the consumer is most and least resilient? Because you make the point that L'Oreal is both, isn't it? It does luxury, but it also has these mass market brands. So what is it telling us about luxury?
Well, I think one thing it's told us is that luxury is not immune to the wider macroeconomic conditions. I mean, for many years it seemed that way. I mean, the luxury sector had an absolute stormer during the pandemic when people kind of trapped at home were buying online. But what we're seeing now is that they are not as immune as maybe we once thought, and that, you know, the downturn in consumer sentiment in the US, as well as concerns about how robust the Chinese demand is for luxury, is actually starting to affect these companies. Of course, it could also just be a normalization of historic trends. I mean, what we saw after a pretty strange few years was that luxury, you know, had huge demand, but that may not always be the same. So we're seeing a normalization.
Okay, a normalization, and that means that the L'Oreal share price down by 2.6% this morning. Deirdre, thank you very much. Deirdre Hipwell from our consumer team. Plenty more ahead. This is Bloomberg.
nurturing also can come from men, and it's one of the qualities, I guess, that you found in your mentors that also pushed you up. Do we need even more nurturing post-pandemic? Is the way that we talk with employees going to change?
I think talent becomes the single biggest differentiator of a successful entity versus an unsuccessful entity. So you've got to do everything possible to hire, train, retain, put your arms around talent. I mean, you've really got to focus on your talent. In the past, it's always been give them money, show them that they have an upward mobility and can make even more money, and that's the only reason people come to work. I think post-pandemic, we are seeing more and more people say, I have to worry about me as a person. I have to worry about my family. I want to worry about my well-being, my mental health. So we've got to start encompassing people as holistic humans as opposed to a tool of the trade, which means that we have to engage with them head, heart, and hands, not just head and hands. The heart has to be engaged. So we have to show more empathy, show that we care, that they're citizens of the community, they're members of the family, and all of those have to come into consideration as we help an executive or an employee be an employee and be a person of the community and the family. The stakes are higher.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. Leaving the door open, Fed Chief Jerome Powell signals a November hike is unlikely, but keeps future rate increases on the table. Treasury yields retreat. Sterling comes under pressure and two-year gilt yields fall after UK retail sales drop more than forecast. The dire data follows the largest drop in consumer confidence since early COVID. Plus, a call for aid. President Biden appeals directly to Americans to support funding for Israel's war efforts, warning that Hamas and Russia pose parallel threats to U.S. democracy. Welcome back to the program. Lots to talk about on the geopolitics front. Before we do that, let's just get a quick check on the markets, because markets responding to the geopolitics, responding to the weakness in some of the earnings reports we've had out this morning, and also to lower expectations perhaps for Chinese construction and what that does to basic resource prices. So we see the FTSE 100 down by 0.7%. Bigger losses, though, on the French market, down by 1.5% on the CAC 40, the Xetra DAX down by 1.3%. And if we put the sectors in focus, you see where some of these stories are coming from. So basic resources down by 1.8%, and that is a bit of a weight on London, and that is to do with weaker iron ore prices and what we're expecting on steel manufacture in China. The bank sector also under pressure, technology down by 1.4%, but consumer products and services is an area of weakness, down by 1.3%. That weighs on Paris, of course. We have L'Oreal's share price, for example, down by 2.5%, so that's certainly one of our themes. Away from the markets, then, let's get some analysis of the latest geopolitics. US President Joe Biden has directly appealed to the American people to support funding for Israel and Ukraine's war efforts. In only his second Oval Office address since becoming president, he warned of the parallel threats to democracy, a message that the European Commission President, Ursula von der Leyen, echoed.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
Vladimir Putin wants to wipe Ukraine from the map. Hamas, supported by Iran, wants to wipe Israel from the map. Russia and Hamas are alike. As President Zelensky has said, their essence is the same.
Let us get some analysis. Julie Norman joins us, Associate Professor in Politics and International Relations at University College London. Thank you so much for joining us, Julie. And you've written a lot about the region. You've written a lot about Palestinians and the broader Middle East context. You've also written a lot about US politics. So very nice to speak to you on the day after we hear from President Biden. We heard there from some clips of President Biden and Ursula von der Leyen putting these two wars that we see right now in context, the ones that are front and foremost for investors at least, and that is the war war in Ukraine, and that is the war between Israel and Hamas. Are we right to lump them together like that, or is that just a function of political necessity for a US president who's trying to get funding?
Well, I would say that this is pretty much in line with Biden's approach to foreign policy with this theme of democracy. And as he rightly, I think, pointed out, Putin and Hamas are very different types of actors, and these are very different types of conflicts, and I would underscore that. But from Biden's perspective and from much of the world's perspective, I think this is some parallel in the sense of an attack on a neighboring country, an attack on democracy. So Biden's really trying to frame it that way for Americans in this speech and underscoring both the interests and the values at stake. You know, he said, if you don't respond to threats like this, these threats just grow. They threaten global security and American security. And he also said this is a time for America to step up and to be a kind of a beacon for the world at a time like this. So I think it'll be interesting to see if that takes resonance or not. There are many who support aid to Ukraine, but not to Israel. Many who support aid to Israel, but not to Ukraine. But this was the common theme that Biden was hoping to portray in this speech.
Yeah, and he's looking for a lot of funding, isn't he? As you point out. So we'll see where that gets him. Interesting that he mentioned, and he in the Oval Office, with all the symbolism that involves, he mentioned mistakes that the US had made in foreign policy and the way that Israel could learn from that, or mistakes that the West has made and lessons that Israel could learn from that. And I'm thinking here about his comments, how he'd cautioned Israel not to respond only in rage. And I wonder about the significance of him mentioning that and what it tells us about US policy towards Israel and the extent or the limits of the West's support.
Yeah, so this is actually a slight shift in the messaging that we've seen from the White House towards Israel since the atrocities 2 weeks ago. Biden came out very quickly with very strong and ambiguous support for Israel's right to defend itself. But over the course of the 2 weeks, we have seen a bit more nuance added to that, some calls to restraint, and very poignantly drawing on the U.S.'s own experience from 9/11 and saying, we know what that feels like. We know the emotional response. We know the rage and the desire to respond to that. But there needs to be a strategy. There needs to be an end game. And to respond only out of rage can only often exacerbate problems even further. So I think that's a message that he gave in Israel, but really importantly also said from the Oval Office last night to an American audience.
Yeah, interesting to see how that message has evolved, and as you say, from the US, but also from others in Europe to varying degrees. Thinking about the Middle East now and what we're seeing there on the ground, Julie, I mean, clearly the humanitarian toll is already huge here, but we are still waiting to see if we get some kind of ground invasion. The longer we wait for that, do you think it will be smaller and more targeted? Are we witnessing something that is evolving? Is the thinking on this evolving?
I do think the thinking is evolving, and I think we've seen that even in the slight delay, if you will, the sense that we've seen several visits over the week. There hasn't been the ground invasion yet, even though I do think that is probably still imminent. This has also been just affected by what's playing out on the ground, the hospital strike most broadly, but also, as you mentioned, just the civilian toll that we've already seen. Israel is aware of how this is being seen around the world. As you noted, the ground invasion hasn't even started, and we've already seen over 3,500 civilian casualties. And so that is playing very strongly around the region. Obviously, Israel is trying to both respond, but also to contain the conflict and to deter this conflict from escalating further. And they, I think, are trying to find the right path to respond effectively to Hamas without making this just explode across the region.
Given your experience of the region, Julie, how would you characterize the involvement of Iran already, and what are you watching in terms of escalation?
Yeah, so Iran obviously backs some of the groups that we've already seen active, Hamas and Palestinian Islamic Jihad, but the group that they probably have the strongest relationship with is Hezbollah in southern Lebanon on the northern border of Israel. So we've already seen some cross-border exchanges, some attacks on that border, but it's not a full front yet. And I think the big question is if Iran fully activates Hezbollah and activates a broader regional war. So that really is kind of the question mark. Obviously, U.S. diplomacy has been in full force to try and avert that through other actors in the region, and also through the military presence that we're seeing the U.S. move into the region, and also by this proposed security bill.
Would this always be by proxies? Would it be by Hezbollah, or would Iran enter the fray in its own name, do you think?
Yeah, it's a big question. I think this conflict could go many different ways, but Iran tends to work mostly through its proxy groups. It has pretty much backed Hezbollah for decades now for this kind of purpose. And again, in the past, this has played more of a deterrence role. So Iran and Israel sort of have a deterrence relationship largely because of Hezbollah's presence there. But again, all that can change very quickly. Hezbollah is very large. It's very well trained. trained and very well armed.
Julie, taking a step back, President Biden referencing how the Palestinians must one day have their own state. We talked for so many decades about the possibility of a two-state solution that feels so far off, given the news lines we've been covering over recent weeks. Where do you think this takes us in that end goal that so many people think is fairly inevitable?
You're right. We have been speaking about a two-state solution for a while. I think it was notable that Biden did mention more of a long-term resolution as part of what's going on, because we're obviously watching the day-to-day events play out very rightly and importantly, but this is obviously in a larger context, and a lot of people are wondering, what will this actually look like? Where will this conflict actually go? I and others, I think, not sure if the two-state solution is, as viable as maybe many thought it was back in the 90s, but it is still the main international consensus. And the more important thing, I think, is to discuss this idea of what might negotiations look like, what might some kind of resolution look like that does actually address the security and dignity and rights needs of everyone in the region.
What makes it not so viable, Julie? I mean, obviously the tensions right now make it not viable at this point, but is it still, do you think that, are you and other sort of policy experts thinking that that is not where this ends up?
Well, I think, as I said, there's still a lot of hope and momentum for that, but there's a lot of realities on the ground that just make that much more difficult in the ways that the two populations are quite overlaid with each other, the different security needs that Israel has maintained and the different needs that Palestinians have maintained just make some of the compromises that would need to be made for a two-state solution a little bit difficult at this time. But again, I would say that's still a model, and there are other models that are also being discussed, and I think all of that is important and all of it should be on the table.
Julie, thanks so much. Thanks for your time. Julie Norman, Associate Professor in Politics and International Relations at UCL. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back. This is Markets Today. 42 minutes into a European trading session that looks pretty negative. The CAC 40 down by 1.2%. The Xetra DAX down also 1.2%. The FTSE a little weaker this morning as well. Extensive losses then across European stocks. Basic resources the worst performing. Travel and leisure, industrial goods and services all moving to the downside as well. Let's talk about the auto sector though. European auto sales maintained double-digit growth in September, rising 11% in the month, despite higher interest rates raising the cost of acquiring a car for many consumers. Joining us now with analysis, Sigrid de Vries, Director General of the European Automobile Manufacturers Association, representing, as it sounds like, the manufacturers. Thank you very much, Sigrid, for joining us. Thank you for your time. So we've seen the 14th consecutive increase in this number and still seeing a sort of post-pandemic bounce back in demand. 16% of the sales now EVs. Is the market developing as you would expect, Sigrid?
Well, indeed, the market is clearly rebounding from pre-pandemic levels, and that's really good. 14th consecutive months of growth, as you mentioned, and we see a strong surge also in sales of electric vehicles, which is where we need to go because the European vehicle industry is in the midst of a significant green transformation away from the combustion engine to zero-emission vehicles of the future, and we really need to have that market uptake, that market pickup for zero-emission vehicles.
So zero-emission vehicles, yes, and 16%, as I say, are now EVs. We're seeing, of course, this data looks very robust, but we're also getting earnings reports coming through from individual car companies, and some of those talking about things like consumer reticence, and I guess that wouldn't be a surprise given the much higher interest rate environment we have, and possibly that pushes up the cost of cars, and EVs often more expensive than legacy models. Sigrid, what are you seeing in terms of the strengths and weaknesses of the European consumer right now?
No, indeed. I mean, it's not about vehicle technology only, making this transformation to green vehicles. We really need the consumer to change habits, mindset, but we also need this charging infrastructure, electricity charging point to be widely available, easily available. We need fast chargers as well, and that is not synchronized at the moment. So we indeed see some consumer reticence still, and yeah, that we need to overcome together with policymakers, with other stakeholders, to make sure that there is enough confidence amongst consumers, not just economic confidence, but also in the ability to use and make good use of these vehicles, and their charging infrastructure is the main worry. Consumers worry mostly about range and about ability to actually charge.
That range anxiety then it lives on perhaps still, even with the extended ranges that we see on offer these days. We also see manufacturers trying to shore up supply chains, trying to source batteries closer to home, trying to build more battery capacity in Europe and close by. How do you rate Europe's efforts to build up battery capacity, Sigrid? What do manufacturers think about that?
It's absolutely on the right track, but it's not going fast enough to meet the targets that we have, and there's fierce competition, of course, with other world regions like the US and also China. So efforts are being made. The industry itself is putting vast amounts of money into investments in this battery value chain, which is really an ecosystem, going from sourcing materials to then refining, having the components built and put together, assembled in battery packs, and then go into the vehicle. And we want that to be established also in Europe, and there's fierce competition at the moment going on with, as I said, China and also the US.
Can I ask you about another big European story, of course, within the car sector has been the launch of the European Commission's probe into Chinese imported vehicles and the extent to which they are subsidized. Sigrid, how do you expect this probe to pan out? And is this really about Chinese vehicles? Is it about Teslas made in China? What are you seeing now in this conversation?
It's too early to say how this will pan out. We take note of the Commission's investigation. As auto industry, we firmly believe actually in free and fair trade on a level playing field between all competitors. I think it's important to realize that free and fair trade has been essential to the creation of a successful European automotive sector. Our industry is per definition really global. It's really been a foundation of our global success. And healthy competition, of course, also drives innovation in European manufacturing and therefore also provides ever greater choice for consumers. So we're looking at this investigation to see, it needs to be robust. It needs to look at the right things. There is, of course, the risk of a retaliation measure. So yes, Europe needs to be more assertive. We also need to hold each other as trade partners accountable, but we're certainly not interested in initiating any trade wars. So there is a bit of caution on the side of the auto industry here.
Okay, some caution on the auto industry's front. In other matters of trade, I know that we're trying to get to a sort of resolution of the post-Brexit tariff environment between the EU and the UK, and there's a lot of focus on rules of origin and when these rules are going to be applied, and talk of whether implementation of these rules is going to be pushed out for a couple of years. Sigrid, what are you expecting to see there?
That would indeed be very, very important. ASEA calls for a 3-year extension of those rules of origin under the Trade and Cooperation Agreement between the UK and the EU. And failure to act could really mean 4.3 billion euros in costs. And also cut EU production of electric vehicles by almost 500,000 units. And that's the equivalent to the output of, say, 2 average size auto factories. So it's really significant. And this comes at a time where we are building up that battery value chain. Massive investments have been made, but those coming online takes a bit more time than many expected because of, unexpected circumstances like the pandemic, but also inflation rates and what have you. So we need more time. We should support that nascent sector to grow and to become online and to be competitive compared with the US and the EU. And that's the overall message I think that we would like to pass. We need to make this massive transformation work. So we need to be able to compete on an equal footing with others in the world. And this massive transformation needs to be supported better by EU policymakers than is currently the case.
Okay. And so you sound optimistic, or you say that you are in the camp calling for an extension there on those particular rules and their implementation. Are you in talks with the European Commission? Do you get a sense that they see things the same as you? Because I think there's been opposition to extending the deadline from the French, for example.
There's recognition, I believe, when we talk to EU policymakers, that there is an issue and that a solution must be found. I don't think there is agreement today at what that solution could be. So we're indeed in talks. We provide information, give our views on how the sector develops, and also the materials and the chemical sectors, for example. And I think that's all important to do, but time is certainly running out. I mean, we're looking at the 1st of January, really cliff edge coming. That's in industrial terms, that's really, really tomorrow. So we need action taken now.
Okay, Sigrid, thank you very much. Sigrid de Vries, Director General of the European Automobile Manufacturers Association. Thank you for joining us. Coming up, we will get back to the markets. We will look at what Fed Chair Jerome Powell's latest comments mean for the international bond markets as the world tries to second-guess the Fed's next move. That's next. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg. This is Markets Today, 8:53 here in London, 8:54. European stocks on the back foot, declining this morning. Geopolitical risk to the fore. Let's talk about what's happening in these markets. Ven Ram joins us from our Markets Live team. And Ven, you've been actually preoccupied with what's been driving the run-up in Treasury yields that we've seen of late. A lot of focus on the long end. Yesterday, we saw this market responding to Jerome Powell, and you're going to tell us the truth. What really has been driving bond yields?
Absolutely, Anna. So if you look at nominal rates, they can be decomposed into a real short-term rate, a credit risk premium, an inflation premium, and a real risk premium. Now, obviously, because treasuries are the safest securities, the credit premium associated with treasuries, with holding treasuries, is zero. You would imagine that, considering that all that has happened with inflation, you would think that the inflation risk premium is high, but surprisingly, when I ran the numbers, it's just at a historical average. So it's not doing very much to the surge in treasury yields. What is really underpinning the current sell-off in treasuries is a surge in risk premium, which captures the risk that interest rates may stay choppy. That volatility associated with interest rates is what driving the narrative. And that is approaching a 3 standard deviation move, which is extremely rare. In a sample running 50,000 times, you would expect to see that occurrence in less than 50 times.
Okay, and more recently, we've seen, of course, Powell talking yesterday at the Economic Club of New York, talking to our David Weston, and some of his comments now filtering across the Atlantic, influencing markets here. How do you see them linked?
Well, I mean, Powell, for all the tightening that they have done, pushed back on the idea that they are going to pivot anytime soon. He said two main things: that there may still be meaningful tightening in the pipeline, and the bigger takeaway was that he told Bloomberg that he thinks the evidence is not that policy is too tight right now. Now, the Fed's real policy rate is some 290 basis points. That's the most staggering of any major central bank. Now, if the Fed says that their real rates are not tight enough, then what happens to places like economies like Europe, Eurozone, and UK, where real rates are even negative in the UK? So we have seen inflation come off a bit in the UK, but if Powell's message is anything to go by, it means that gilts can't rally too much from here. And that's the key takeaway.
Okay, Ben, thank you so much. Thanks for your analysis. Ben Ram from our Markets Live team. Remember, you can get up-to-date analysis from Ben and Mark and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. That is it for Markets today. We will bring you further coverage of these markets on the Pulse. This is Bloomberg.
race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. President Biden appeals directly to Americans to support funding for Israel's war efforts, warning that Hamas and Russia pose parallel threats to U.S. democracy. Fears of a weekend escalation in the Middle East drives gold higher and oil passes $90 a barrel. And then the Fed chair, Fed Chief Jay Powell signals a November hike is unlikely, but keeps future rate increases on the table. Treasuries rise, but the 10-year yield remains close to 5%. So let's take a look at the European market map. Again, a lot of the political risk playing out in the markets. We're seeing across the board equities falling. Investors really trying to respond to the threats of a weekend of escalation in the Middle East conflict. The FTSE down 0.4%. The FTSE MIB over in Italy down 1%. The focus firmly also on oil, trading above $90 a barrel. Gold actually approaching some $2,000 an ounce. Again, this is after we also had multiple reports from the Pentagon about drone attacks in Iraq and Syria. Look out from the risk premium in the price of gold, and that's, of course, moving U.S. 10-year yields, as with other Treasury yields, the U.S. 10-year for 9.350. So President Biden warns that Hamas and Russia's Vladimir Putin pose parallel threats to U.S. democracy. He appeals to Americans to support funding for Israel and Ukraine's war efforts.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
Let's get the latest now from Bloomberg's Oliver Crook in Tel Aviv. Oliver, a rare Oval Office speech from President Biden. How has been this taken? What else did he say?
Yeah, so Francine, a rare, as you say, address from the Oval Office, really reserved for the more solemn and more important messages that the president delivers, and delivers directly to the American people. And one of the questions he asked sort of rhetorically, but set out to answer, is why does this matter to the United States? And the point that he made was with both with dictatorship and with terrorism, they need to pay a high price because there is no sort of limit to how far they will go. And he appealed directly to the American people, in part because he's also going to be asking the American people for a lot of money. We understand more than $100 billion And we have some reporting on this, on where that money will be spent. We understand that $60 billion of it would be for Ukraine, $14 billion for Israeli defense, $10 billion for humanitarian efforts, including Gaza, $14 billion for the efforts to secure the southern border and to deal with fentanyl trafficking, and $7 billion for other national security concerns around the world, including the Indo-Pacific and Taiwan. It also came with some warnings to Israel. Again, he evoked 9/11, saying that a lot of mistakes were made in the United States and Israel should not act out of rage. He also talked about the Palestinians, saying that basically just because of these attacks from Hamas, that does not forfeit their right to freedom and to live peacefully and out of danger. But that being said, we are now entering the 14th day of this conflict, and the aid is still sitting at the southern border of Gaza with Egypt, has not yet crossed through Rafah.
Oliver, what's the latest on the ground that we know of?
So we understand that there have been more strikes on Hamas, more strikes within Lebanese territory on Hezbollah as well. We're also hearing from that the United States is saying that there have been more attacks on their installations in Syria and Iraq. And we also understand that the U.S. Navy has intercepted some missiles that are coming from Yemen, apparently directed towards Israel. There is a small matter of a very large and very significant country that sits between Yemen and Israel, and it is Saudi Arabia, which is why our attention now turns to what we understand is a summit that is still very much up in the air in terms of detail that will be held in Cairo tomorrow, starting from 10 a.m. And again, according to sources familiar, and we should say all of this is in flux, we understand it will be attended by the Crown Prince of Saudi Arabia, Mohammed bin Salman, the President of Turkey, Erdogan, as well as the King of Jordan, the EU Council President, and the foreign ministers from the UK, Germany, and France. And this we need to see, and again, the main concern here is going to be preventing spillover and how do you deal with some of the refugees in Gaza, but also getting aid into Gaza.
Oliver, thanks so much. Oliver Crook there live in Tel Aviv for us. Now let's look at this potential broader geopolitical implication of a conflict. The Pentagon says America is seeing stepped up drone attacks in Iraq and Syria. Meanwhile, a U.S. destroyer in the Red Sea has also intercepted cruise missiles and drones fired towards Israel by Yemen. So let's bring in our Bloomberg News director for the EMEA region, Roz Matheson. So Roz, thank you for joining us. When you see these escalation of reports of drone attacks, everyone is on high alert. Again, how does this escalate? It feels like it's at boiling point.
Well, that's right. In fact, though, drone attacks and similar things on U.S. bases in Iraq where U.S. troops are stationed and so on, things being fired by Yemen, that's not unusual. That happens quite often. But in this environment, of course, it's just feeding into that broader concern about contagion if there is a ground war inside Gaza soon by Israel. And what does that mean? And we know, of course, the U.S. ships intercepted those missiles and drones fired by Houthi forces inside Yemen that seem to be going towards the north, potentially towards Israel. And the fact they intercepted those missiles, does that show us the risk again the U.S. militarily could get drawn into a conflict in the region? So certainly those things taken together, the risk to energy infrastructure from all of these drones that are flying around, missiles and so on, the U.S. military, it just adds up to that wider concern.
Roz, I don't know what you make of the rare Oval address, actually, by President Biden casting Russia and Hamas as parallel threats to democracy. It doesn't feel like it's trying to de-escalate.
Well, certainly the U.S., again, the rhetoric has been very, very strong towards support for Israel in recent days. We saw that with his visit to Israel. We saw it in the visit by the UK Prime Minister, Rishi Sunak, also, I mean, talking about Israel, wanting Israel to win in this, for example, by the UK. So certainly, if anything, if you're the Israeli administration, you're taking that as a green light to go ahead. And they've said that they understand that Israel feels the need to respond to the attack on October 7. The question is, are they trying to coax Israel behind the scenes into a more targeted ground invasion?
Roz, what about some of the, I guess, energy infrastructure could be targeted? Is that a serious threat?
It is certainly. Right now we're seeing oil move more and just the sort of broader general political risk around all of this alongside other global markets. But the risk is, of course, with Iran involved. Iran's a big oil player in the region, and so are some of the other big states that are nearby. And of course, Iran has said repeatedly it's prepared to target energy infrastructure. We're talking about oil tankers going through the straits in the area, right? And so any of that does become an elevated risk, because then we're talking not just about how markets are perceiving risk, we're talking about oil supply which is a tangible. And of course, if oil supply gets disrupted, oil prices go up. We're in an environment already still of an elevated inflation. You're talking about a real potential big hit to the global economy.
Roz, first and foremost, it's also about humanitarian aid. There have been here and there, talks that things could get moving, but is this going to make a significant impact to the people that need it most?
Well, as of this morning, so far none of that aid is still going in, despite what we heard was an agreement to allow 20 trucks to start moving through that crossing, the Rafah crossing between Egypt and Gaza. No aid whatsoever. And even then, 20 trucks is not going to make that much difference when we're talking about the scale of the humanitarian challenge inside Gaza at the moment. We know the reports from inside Gaza are pretty bad in terms of need for medicine, food, drinkable water, and so on. And 20 trucks is not going to make a significant dent in that, particularly if they're the only 20 trucks that get through in the end.
Roz, thank you so much. Roz Matheson there, Bloomberg's news director for the EMEA region. Now, let's also talk about, of course, the market impact from these rising geopolitical tensions. With us is Paul Dobson. Paul, we were talking there about the potential hit also to infrastructure, but as we're continuing to follow this and unravel and trying to figure out where this ends, what does it mean for where the perceived risks on the markets is? It seems like geopolitics is dominating everything.
Well, yes, it's one of the key factors. And good morning, Fran. I would say, that's part of what's dominating things. The other thing, of course, is the outlook for U.S. interest rates and Fed policy. And those two things, I think, are creating some interesting tensions and dynamics within the markets overall. So particularly this is playing out with when you're looking at the U.S. Treasury market itself, where we've had rising interest rates at a time when you might otherwise expect for bond yields to be going lower, for people to be putting their cash into the bonds market, looking for it as a haven or a safe place to store your money, or possibly a hedge where you can get some price appreciation if the situation does deteriorate. But it's not been working. It's not been working because this is a Fed that's not minded to cut interest rates anytime soon. And if you're betting on a global risk event, you're betting that the mechanism for that is going to be that the Fed will cut, and therefore your bond prices will appreciate. The Fed's not having any of that right now. In any fact, possibly a rise in the price of crude oil, as Roz was discussing just then, would be inflationary and push the Fed to think about higher interest rates, not lower. So therefore, Treasuries are not really working as that haven play, and that's having repercussions right across the rest of the investment landscape as well.
Yeah, and Paul, what we heard, of course, after those comments by the Fed Chair Jay Powell is actually what surprised me was a divergence, a quite big divergence between the 2- and the 10-year yields, amongst the biggest that the market has seen, I think, since March. What does that tell us about, again, I guess the bifurcation of what Treasuries could do on the back of some of the geopolitical concerns? We also need to get used to this idea that we're higher for longer, and I don't know how much of that is priced in.
Yeah, I think, well, the market is getting better at pricing that message in, but maybe not done yet. I mean, what the market took away from Powell was two things, it would seem. One, a November rate hike is off the table. He was talking about a patient approach. He was lauding or talking up the deceleration of the pace of Fed hikes this year and how it pays to wait a little bit and see how that's playing out. He was also talking about the rise in longer-term interest rates and how that is actually helping the policymakers a little bit in terms of squeezing financial conditions. So there's a bit of a reciprocity here between bond market and Fed policy, a bit of a feedback loop that's going on, a push-me-pull-you effect kind of thing. But what the market is doing at the back end is pricing in not only like a persistence of higher inflation that's going to mean a higher policy rate, but also a bigger risk premium because of the supply of bonds that's coming into the market, because of the spending and because of what that means for, the future outlook, both in terms of credit risk as well as in terms of monetary policy.
Paul, thank you so much. Paul Dobson there from our MLive team. Now, coming up, China offers a record cash injection to keep rates low for growth. So we'll have plenty more on that next. And this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
We have a lot of challenges in the U.S.-China relationship. We do not have identical views on this particular position. Hamas does not support the two-state solution. Hamas supports the destruction of the state of Israel. China has taken a position of supporting the two-state solution, as has the United States. And so obviously, the focus here should be directed against Hamas.
Well, that was Nicholas Burns, the U.S. ambassador to China, speaking to Bloomberg's Stephen Engel. Joining us now for a look at the markets and geopolitics, Claudia Panzeri, Chief Investment Officer, France for UBS Global Wealth Management. Claudia, as always, thank you for joining us. Geopolitics and, of course, Powell comments seem to be driving the markets. What kind of dynamics do you see in the next couple of weeks and months?
Good morning, Francine, and thank you for having me today in Bloomberg. So it's a very difficult combination between tightening monetary policy, Fed's comments, which are highlighting the fact that trade will stay higher for longer, and at the same time increasing tension in the Middle East. Yesterday's move on the bond on the bond yield, I think, is also linked to the fiscal situation in the U.S., where it's been announced an increase in defense spending, $100 billion. And the short term was just moving down because market is probably not expecting more rate hikes to come by the end of the year. So the tension between the long and oil price up, break-even also moved yesterday, I think is putting volatility on the upside. And we need at least a few elements out of the Middle East and some, let's say, less pressure on the oil price before seeing the market resuming back to the previous high, which probably takes still a few days.
So, Claudia, and you talk about these conflicting forces actually pulling on the markets. Where do we end up? Is it impossible at the moment to actually call something because of the price of oil, because we don't really know if it's higher for longer, or certainly if we have more increases, if we've reached peak interest rates yet? And so how do you build a portfolio on the back of all of this uncertainty?
So first of all, we have been having energy in our mandates, in our strategy since the beginning of the year, and also since the last year. I think since we had the conflict between Ukraine and Russia, we understood that energy was a good edge for every geopolitical tension. Secondly, we are trying to be exposed less to equities, even if we have a neutral position, but having a big exposure to bond yield, not on the long end of the yield curve, but probably more in the middle, between 5 and 7 year duration. High quality bonds is true. There is some volatility around the yield itself, but clearly if you have a slowdown because the oil price is rising, the tension is getting even more concerning in the Middle East, at one point the bond yield should start to fall. There is something which is not discussed enough in the market, actually. Everyone is discussing about the capacity of the Fed to hike rates but people do not speak about the capacity of the Fed to inject liquidity again. I mean, quantitative easing is ongoing, the balance sheet has been shrinking, and we are getting back to previous pre-COVID level very, very fast. So the Fed could start to inject liquidity back and stabilize, reduce the volatility on the long end of the yield curve.
But so, Claudia, overall, what does it all mean for financial conditions? And is there a worry that the consumer will really slow down significantly? Maybe we hear also cracks, if not in the U.S., in other parts of the world in terms of labor market in Europe and the U.K., and that we see a downturn before the central banks can act?
Exactly. I think this is very important to look into financial condition, because while financial conditions have been easy despite this rise in the bond yield, now that you have energy price up, the dollar appreciate again, the market, which is down, volatility is up, financial conditions are getting very tight, and the Fed will be watching this very closely, which will also impact the Fed monetary policy. Financial condition is one of the elements that the Fed is looking at. That has already some impact on consumption. We see on the earnings season some companies saying that consumer is slowing, but is not slowing in the same way everywhere. U.S. is still up. We have seen the data out of this week and last week, which was still very strong. We feel probably a bit more bite into the Eurozone and outside the Eurozone. Yeah. And this is because the Eurozone is more linked to the energy price than in U.S.
Claudia, what would a policy mistake look like from central banks today?
For central bank, it's getting difficult because there is no enough, let's say, visibility about growth. People have been surprised on the upside in U.S. At the same, inflation is slowing down, but not quickly enough for the Fed or another central bank to cut. So they are a bit forced to keep this rate at very high level into a slowdown, which is the reason why markets are so volatile. But once again, I think the rate is one thing and the work down on the balance sheet is another. So central bank may start to balance the work between short-term rate and the long-term rate bond yield with some work on the balance sheet, and probably start to think about quantitative tightening in a different way.
Claudia, thank you so much, as always. Claudia Panseri there from UBS Global Wealth Management. Now, of course, throughout the hour, we'll have plenty more on the fallout from the rising Middle East tensions and, of course, the move on U.S. yields following Fed Chair Jay Powell's comments. Stay with us, and this is Bloomberg.
Was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight. In manufacturing, labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now let's get to some of the top red stories on the Bloomberg terminal this morning. And UBS is set to start its next wave of job cuts at Credit Suisse on November 6, targeting about 10% of staff. Well, that's according to Financial News. The report says risk, compliance, and marketing roles are likely impacted. UBS declined to comment. Separately, the bank says the board of directors for the Swiss units of both UBS and Credit Suisse will be restructured and harmonized as of November 1st. Roger von Mentelen will be appointed chairman of both boards. In the U.S., Republican lawmaker Jim Jordan says he will seek a third floor vote on his bid to become House Speaker. That's after he abandoned a backup plan to expand the interim speaker's powers and buy him time to get more support from fellow GOP lawmakers. Well, Jordan fell short of the votes needed to become speaker in 2 rounds of balloting this week amid objections to his hardball tactics and deep divisions within the party. Shares in L'Oréal have opened lower after sales in North Asia unexpectedly fell in the third quarter. Now, the cosmetics maker is grappling with a challenging travel retail environment around the world. The beauty company posted 11% sales growth overall, thanks to better than expected performance in North America and Europe. Intel and Siemens are pulling out of Europe's biggest tech conference after the event's leader criticized Western support for Israel following the Hamas attacks. While prominent venture capitalists, including eCombinator's Gary Tan and Sequoia Capital's Ravi Gupta, have also canceled plans to attend next month's Web Summit in Lisbon. The event's organizer, Patty Cosgrave, has apologized for his remarks. Coming up, President Biden has appealed directly to Americans to support funding for Israel and Ukraine's war efforts, just ahead of the EU-US summit today in Washington. We'll have the full details next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there
the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
President Biden appeals directly to Americans to support funding for Israel's war efforts, warning that Hamas and Russia pose parallel threats to U.S. democracy. Fears of a weekend escalation in the Middle East drives gold higher, and oil passes $90 a barrel. And Fed Chair Jay Powell signals a November hike is unlikely, but keeps future rate increases on the table. Treasuries rise, but the 10-year yield remains close to 5%. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. President Joe Biden is warning that Hamas and Russia's Vladimir Putin pose parallel threats to U.S. democracy. Well, Biden is appealing to Americans to support funding for Israel and Ukraine's war efforts. Let's get the latest now from Bloomberg's Oliver Crook in Tel Aviv. So, Oliver, just bring us a little bit up to date about what's happening this morning.
Yeah, so as you mentioned, the sort of main headline is out of Biden overnight, because really appealing to the American people, trying to get their support, yes, for Israel, but also for Ukraine, and as a result, joining these two issues together, saying that both terrorism and dictatorship don't really know any limits, and that as a result, they need to pay the price. And he's going to the American people directly, because he's coming next to the American people for a lot of money. More than $100 billion, we understand, is going to be the ask from the White House for a number of things. We also understand from our reporting, $60 billion of that will be for Ukraine, $14 billion of it for Israeli defense, $10 billion for humanitarian efforts, including Gaza, and then some more, sort of $20 million for various other needs for the nation and national security. He also came with a warning for Israel, saying, do not let rage blind you. You need to be very strategic about what your goals are with Hamas, and to make sure that you're pursuing them and not missing them. He also spoke of the Palestinians, who he says have not forfeited their right to peace and to live undisturbed and not in a war zone, just because Hamas has triggered this attack. Now, the question is, what comes next? The ground offensive, we still have no clarity on timing. We know there have still been attacks in Lebanon, in Gaza by the Israelis, but also the fear of ratcheting up and of the spillover effects. We hear that the United States has intercepted missiles now coming from Yemen, and the question is, and the attention will turn now to Arab leaders, who we understand will convene in Cairo tomorrow. We understand that will be with Mohammed bin Salman, the president of Turkey, and foreign ministers from a number of Western countries. And really there is going to be a question of de-escalation, but also how to get aid into Gaza, which is still not crossing the border.
Oliver, thank you so much. Oliver Crook there live in Tel Aviv. Now, the U.S. and the EU have reached, or have yet to reach, a deal on steel and aluminium ahead of a summit in Washington. Initially seen as a bilateral summit to discuss mostly trade relations, geopoliticals around the Israel-Hamas war have injected new urgency to the gathering. Now, for more, we go to our Europe correspondent, Maria Tadeo in Brussels. So, Maria, a summit under the focus of geopolitics, what can we actually expect?
Yes, Francine, very much. And today you have a big delegation of European officials in D.C. It is led by the head of the European Commission, Ursula von der Leyen, but you also have the president and the head of the European Council and the top European diplomat. And already the fact that he accompanied them on this trip tells you so much. As you say, this was supposed to be about trade, about business, but obviously it has been now, I'm not sure fully eclipsed, but definitely now fully engulfed and immersed in the geopolitics. And yesterday, to me, also striking in tone that the head of the commission repeated very similar to that line that President Biden took himself, saying at this point, we're looking at major instability in the world, and there is a common thread between Hamas and Russia. Let's take a look.
Vladimir Putin wants to wipe Ukraine from the map. Hamas, supported by Iran, wants to wipe Israel from the map. Russia and Hamas are alike. As President Zelensky has said, their essence is the same.
And that is Ursula von der Leyen, the head of the European Commission. Beyond that, too, Francine, she makes that comparison very similar to President Biden. She also said, certainly from the European perspective, there is now an urgency to get the humanitarian angle going. And then she also suggested, which is interesting and very aligned to the U.S., too, that at this point, it is clear that obviously relations when it comes to normalization of Israel and other Arab countries have been paused, but it would be a failure of diplomacy if Israel gets cut off from the region, almost suggesting that maybe at one point escalation may not be inevitable and you can go back to diplomacy in the region.
Maria, is there anything else that we should be looking at from the European side?
Yes, and it comes down to the trade. Again, the focus should have been the trade, but obviously the timeline has changed. But there are two critical issues that could come out of this meeting. Remember, there are still pending conversations on steel, aluminium, and also the critical minerals. The idea, Francine, and this is important, is that this meeting would bring about a deal on steel and aluminium. Remember, President Trump put tariffs on those two metals. Then the European Union retaliated. When Biden got into office, they decided to suspend it and review it. The idea is that today they would come with a permanent deal that would put an end with the saga. Having said that, overnight, Bloomberg News reporting that they are not close to a deal. And in fact, you may get to a situation where there is no deal on the steel and aluminium. That is known as a GSA. So yes, you see that on the diplomatic front, they are aligned, but maybe perhaps on the trade, not so much. And that points to the tensions that we see so sometimes on the Made in America versus the Made in the European Union.
Maria, thanks so much. Maria Tadeo there in Brussels with the very latest. Let's also just have a look at treasuries, because really this was the big story yesterday on the back of Jay Powell. Now, I think we have a board up, including treasuries. Treasury yields really underwent a pretty big shift in reaction to comments by the Fed Chair Jay Powell, with short-dated ones declining actually on the prospect of the central bank not raising its policy rate further, while long maturities climbed to new multi-year highs. Now, if you look at yields across the Treasury curve, it's risen to new multi-year highs. Earlier on Thursday, the focus is not only on Powell's remarks, but of course it's also on some of the geopolitical questions out there. Now, I would mention this. During the question and answer session following his prepared remarks to the Economic Club of New York on Thursday, Powell said policymakers were cognizant of the rise in long-term yields and broadly felt it was helping to tighten financial conditions. Now, to talk about geopolitics, joining us now is H.A. Hillier. He's Senior Associate Fellow of the Royal United Services Institute. H.A. Hillier, thank you for joining us. When you look at the risk of geopolitics, really from here escalating, it's unclear what the ramp-off would be like. Are you worried that geopolitics just bring more volatility with actually really anything is possible at this point?
I think that's a very reasonable concern to have. Of course, it depends on where we go over the coming few weeks, because there are different scenarios. If Israel continues to bombard Gaza in the manner in which it's been doing it thus far, the risk for widening this to a regional conflict, of course, increases. if a ceasefire is come to and humanitarian aid is agreed upon and gets into Gaza, then the risk of regional expansion of the conflict in that regard diminish. So I think in that regard, it's really down to the decisions that are taken, particularly by the Israelis over the coming few days.
So what do you think will be the most crucial in the next couple of days? Do we know that there are back channels to try and de-escalate the situation and help the people that need it most?
There are back channels, but the problem is that there have been a number of agreements that have been stated from D.C. by Secretary of State Blinken and by others on things like getting humanitarian aid into Gaza through the Rafah crossing. And they've been announced several times now, but then the Israelis sort of balk at actually implementing the agreement. So even today, there should be convoys going through. By the way, convoys that are incredibly minimal. I mean, you need something around, according to the UN, I think it was around 100 different trucks every day in order to satisfy the incredible need that is currently in Gaza at the moment. And there was an agreement for something like 20 today, and they still haven't been able to get through. So I do think that part of the problem is that we're coming to agreements and arrangements, but there isn't follow through.
Who do you think could make a real difference in this? Would China get involved?
No, I don't think the Chinese or the Russians really have much play in this particular conflict. I think this is mostly an American and European conflict in terms of influence from the outside, and primarily from D.C. I think actually it was mainly due to visits by American and European officials and politicians to Israel over the past week, which has actually held back the prospect of a ground war, an invasion of Gaza fully by the Israeli forces. I don't think it's about Russia or China, quite frankly. I think the Russians are quite pleased to see the United States get somewhat embroiled in this crisis because it takes attention away from Ukraine. The Chinese, I don't think, are particularly interested in getting involved. I think they correctly recognize they don't really have much play on the ground in that regard.
What do you think happens in the next couple of weeks? Again, what's the risk to the upside and the hope for de-escalation?
I think the risks are very real because, you've had thousands of Palestinian civilians lose their lives over the past week. Of course, there's an incredible amount of anger within Israel because of the terrorist attack on the 7th of October by Hamas into Israel proper. You have an incredibly dire, and I mean incredibly dire, humanitarian situation unfolding in Gaza, which is, as your viewers probably know, it's an incredibly densely populated area, 2.1 million or so people in an incredibly enclosed space. The risk of Palestinian refugees having to leave Gaza, go to a place like Egypt and never be allowed back. This is also one of the factors that is driving public opinion in places like Egypt and Jordan, where they see the prospect of ethnic cleansing, at least in parts of Gaza, of Palestinians to be quite real. And frankly, they have historical precedent to rely on that. Drawing in other actors in the region, you have countries that were developing good relations with the Israelis, and they are now condemning the Israelis because of what's happened over the past week. You have the Saudi-Israeli normalization talks. They've not been officially suspended, but they're certainly on cold freeze. And I think it will take quite some time for them to get back to the place where they were. So Iran, of course, is in play. I mean, there are different factors here that could really spill out of control very quickly.
But unless there's sizable humanitarian aid that's being given now, are the risks that actually this escalates? And why is it so difficult to bring humanitarian aid to where it's needed?
So yes, there is that risk if we don't get humanitarian aid in and the civilian casualties continue to mount on the Palestinian side. I think you see increased pressure across the region for powers and governments to get more involved, and that can regionalize the conflict in a way that I think would be very dangerous. Why is this so difficult? I mean, frankly, because as I said previously, arrangements are being come to, and they're not being followed through. And I have to say, primarily on the Israeli side, the Egyptians have got the humanitarian aid waiting on the border. There's scores of trucks just waiting to go across, but the Israelis won't let them in.
Thank you for joining us. A.J. Haley, there, Senior Associate Fellow at the Royal United Services Institute. And of course, you can follow us for more analysis and the crossover to what it means for the global economy. Coming up, the Fed Chair, Jay Powell, says he sees current policy is not too tight, leaving the door to future hikes open. What does that mean for the Treasury markets? Our MLive team joins us to discuss that next. And this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. Some of the things that one reads about now remind me of growing up in Mississippi.
There's a lot of uncertainty around lags, and one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is?
Long-run potential growth is not something that moves around a lot over time, but I would, my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour productivity growth, you get something around 2%, and that's higher than most other advanced economies.
Well, that was the Fed Chair Jay Powell speaking to Bloomberg's David Weston. Now here with us to talk about all things Fed and also surging Treasury yields are Bloomberg MLive strategist Ven Ram. So Ven, thank you for joining us. I really enjoyed looking at all of your analysis on the Bloomberg terminal. What's the real reason why Treasury yields are surging this late in the cycle?
Morning, Francine. If you decompose nominal rates into a real short-term rate, a credit term premium, an inflation premium, and a real risk premium, now obviously the credit premium associated with treasuries is zero. But what has been a bit of a surprise is even though inflation is elevated, when I ran the numbers, inflation premium is around the average it has been historically. So that's not contributing to the surge in treasury yields. So what is contributing to the surge is the volatility, which is measured by the real risk premium. And that real risk premium, as the chart shows, is elevated. And if you run the standard deviation on that, that shows a near 3 standard deviation. We don't get a 3 standard deviation move in something without it impinging on other assets. And that is what we are seeing playing out in the treasury markets.
So, Ven, what was your main takeaway from Powell's speech yesterday?
I think there were two key things that jumped out at me. One was the fact that he said that even though we have been tightening for a long time, there may still be meaningful tightening in the pipeline, which is kind of hawkish. And then he said, to good measure, that I think the evidence is not that policy is too tight right now. Hang on, the Fed has raised rates a lot in the cycle, and then the real policy rate, adjusted for inflation, is 290 basis points. That's the highest of any advanced economy that I'm looking at. And if the Fed says that, look, even now the policy rate is not too tight, that shows how hawkish the Fed is. And it also speaks to Powell's mindset at the moment. It speaks to the inner Powell in him. And that, to me, was the biggest takeaway from what he said yesterday.
Ven, thank you so much. Bloomberg's MLive strategist there, Ven Ram. Now, remember, you can get up-to-speed analysis and insight from Ven and the rest of the team. Just go to MLive Go on your Bloomberg terminal. Plenty more to come. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The conversations that matter, the insights you need. This is the Pulse. I'm Francine Lacqua here in London. Now, the pound dipped after UK retail sales tumbled more than expected in September. Joining us now is Bloomberg's Lizzie Burden. So, Lizzie, we also have comments from the Bank of England governor, but on the retail sales numbers, how do they play into the BOE's thinking?
Well, markets seem to have looked through those comments from Andrew Bailey saying that wage growth's uncomfortably high. They seem to be reacting to the retail sales numbers. And we've been waiting a long time to see cracks in the resilience of the UK economy. Here it is, under the weight of all of those rate hikes from the Bank of England. So retail sales falling more than expected in September. You did have this unusually warm weather in that month. And we know that Brits don't like to buy clothes when there's the slightest bit of sunshine. But it's not just to do with that.
And rightly so. Let's all go in the park to enjoy it.
Yeah, no, we get laughed at for it. But consumer confidence also saw its sharpest drop in this month since COVID. So it shows that as unemployment's edging higher, when you've got inflation biting into household budgets, it's really taking its toll. And so where does it leave the BOE? Well, this fall in the pound suggests that traders at least think you're going to have a more hawkish Bank of England.
At the same time, so Labour leader, so opposition leader Keir Starmer must be having a pretty good Friday after the by-elections.
Yeah, he must be skipping around his house this morning. This was the first opportunity to take the temperature of the nation after the party conferences and also ahead of the general election. And they've overturned two huge Conservative majorities in these two by-elections, really just to mark the scale of it. Mid-Bedfordshire had been Conservative since 1931. You've seen three wins for Labour in by-elections with swings over 20%. That hasn't happened since the run-up to the 1997 landslide under Tony Blair. So it is going to put a spring in the step of Keir Starmer. But on the flip side, to put some cold water on all of this, it isn't a national poll. We're still a way away from a general election. And Starmer's got almost twice as many seats to turn over than Tony Blair had in the run-up to 1997 because of just how badly Jeremy Corbyn did against Boris Johnson. Nonetheless, this is not the mood music that Rishi Sunak's going to want to be hearing while he's jetting around the Middle East doing his diplomacy, or as he tries to set up his general election campaign. So the question must be, is he going to put the general election off right to the 11th hour till January 2025?
Lizzie, thank you. Lizzie Burden, Bloomberg's UK correspondent. Now, here's what else we're watching today. European Commission President Ursula von der Leyen and European Council President Charles Michel will meet President Joe Biden in D.C. for a joint summit for the first time in 2 years. Then at 1:30 p.m. UK, we get Canada retail sales. This is as inflation in the country unexpectedly slowed, leaving room for the central bank to hold interest rates steady next week. Half an hour later, the Fed's Patrick Harker speaks in Philadelphia about the U.S. economic outlook. And finally, American Express reports third quarter earnings. This is a picture for cross assets. We have seen quite big swings over the last 2 weeks. Today, equities are falling, responding to the threat of a weekend escalation in the Middle East. Now, on the back of it, we've seen Brent crude go up in the last 2 weeks, up 10%. Gold, also in the last 2 weeks, up 8%, with a bit of pressure over the last 2 weeks in the European Stock 600, down 1.8%. This is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Manish Cranning.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Geopolitical risk rises on multiple fronts for the U.S., with the Pentagon reporting increased attacks on U.S. bases in the Middle East. President Biden appeals to Americans to support the war effort.
Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
Chair Powell signals a hold for the Fed's next meeting while leaving the door open for future rate hikes, citing the inflation is still too high. And UBS gears up for a fresh round of job cuts at Credit Suisse, targeting around 10% of the support staff. That's according to Financial News. We'll have more on the story through the hour. A very good morning. There's two messages, one for the short end of the curve and one for the long end of the curve. And at the moment, the duration hunters have arrived in the bond market. We're seeing yields drop on the 10-year government bonds. We ramped up by 30 basis points in the space of 5 days. The short end of the curve, 2 years, rolled down. They heard the message, proceed carefully, and persistent changes in FCOM. But the bond market, you've got to ask yourself whether this is a moment of inflection. Lots of people have said it. We will race to 5%. Yesterday, I used the phrase kissing 5%. Well, Morgan Stanley say when treasuries get up there, they are going to be a roaring buy. Now, when it comes to the prism of risk and cross-asset risk, by the way, the biggest steepener, we saw 13 basis points of steepeners go through yesterday. So it really is the long end living in fear. The oil market ramps higher, the second week of advances since this war between Hamas and Israel has erupted. This market has put on 9%. This is the prism of escalation. The U.S. seeks to buy for this special petroleum reserve. What does that do? Allow the Saudis the caveat to release from their unilateral cuts, and gold is actually performing as perhaps a better haven than elsewhere. This is a 13-week high, up 2.4% on the week. Every single day of conflict has given you $13 on the price of gold. Danny, good morning.
Good morning, Manus. And it's probably unsurprising if we're moving into havens, we're buying bonds, we're buying golds, that risk would not be doing well. It was a very choppy session yesterday, and it turned from a choppy one to a terrible one following the comments we heard from Fed Chair Powell, following heightened geopolitical risk. That carries through the future session, S&P down 0.1%. Bank of America, in their flow show, says that sentiment is so bad that it's a contrarian signal to buy, at least for a short-term rally. That bad sentiment carries through to European equities. We're now trading at the lowest since January. Essentially every single sector is down in the European trade today. China also having a tough go of it. The Asia session down 0.6% for the CSI 300. Manus, we've made a round trip. We have now erased all of the gains since we saw last year when China reopened. Morgan Stanley says do not buy the dip. We need to see the economic fundamentals improve first. Now, back to that Powell speech. I want to show our audience, Manus, and for our radio listening audience, what happened to break-evens, because we saw a clear impact from Powell's speech. Break-evens shot up yesterday for the 10-year, about 2.5%. That is the highest level since March, since the banking failures, Manus. It does seem that this market is starting to move away a bit from Powell and re-exerting some skittishness when it comes to long-term inflation.
I think what you've got, Danny, is that the longer end of the curve lives in daily fear and peril of a resurgence of inflation, number one. And two, they do not understand what higher for longer is. There is a lack of definition and a lack of clarity of that. And for as long as you have that, you are going to have this re-steepening of the curve. We can ask our guest, Andy Bremer, in a moment whether this is a steepener exhausted or one which is just about to deliver into positive territory. Let's turn the conversation back to geopolitics, Danny, because it's pervasive in all of our stories. In a rare Oval Office address, the President, Joe Biden, appeals to Americans to support funding for Israel and Ukraine's war efforts.
Tomorrow, I'm going to send to Congress an urgent budget request to fund America's national security needs, to support our critical partners, including Israel and Ukraine, is a smart investment that's going to pay dividends for American security for generations.
Let's get the very latest with Bloomberg's Oliver Crook in Tel Aviv. Oliver, what else did President Biden have to say? What was the core focus of this rare Oval Office address?
That's right, Manus. As you say, it's a rare Oval Office address. This is really hallowed ground where the president goes to speak directly to the American people, but also on sort of solemn and important occasions. And really what he was trying to do was to liken the terrorism of Hamas, as he would say, and the dictatorship and totalitarianism, he says, of Russia, saying that these two know no limits and they need to pay the price, right? And this he is linking directly to American security, national security needs, and he went straight to the American people to appeal to them. Why is he Israel needs to act not out of rage. He also mentioned the Palestinians, man, as he said that they did not forfeit the right to peace and to self-determination just because of Hamas's attack. That said, 14 days into this, the aid has still not crossed the border.
And 14 days in, Oliver, and another day where escalation risk is front and center. What is the fear at this moment? What could happen?
Well, Danny, the sort of mood music behind all of this is that Hamas has called for another day of rage today, and one that we saw last week when thousands took to the streets around the Islamic world. And it comes also as Israel continues to strike in Gaza, continues to strike in Lebanon. We understand the Israelis are evacuating more people by the Lebanese border, but we also understand that the U.S. is coming under more fire, the Pentagon says, in its installations in Iraq and Syria. Also, intercepting missiles, they say, coming from Yemen towards Israel. There is the small matter of a huge country of huge importance that sits between Yemen and Israel, and that is Saudi Arabia. So our attention will now turn to a summit in Cairo, a peace summit, we understand. This is completely in flux, but according to people familiar who have knowledge of the organization of the event, it will be attended by the Saudi Crown Prince Mohammed bin Salman, the President of Turkey. There will be members of the EU present, and also the foreign ministers of the UK, Germany, and France. And again, this is going to be #1 priority is not escalation.
What's interesting, of course, that you're going to have the UK and France there in the midst of that Arab axis. Those countries have hugely important ties with each of those members. When will Israel move into Gaza? 7 days ago, the three of us were talking about the risk of a ground invasion. The narrative around that type of ground invasion seems to have changed, Oliver, and perhaps that is the nuance that we need to grasp as we go into the weekend.
Completely, Manus. You've hit the nail on the head. What we do know, and again, we're trying to read tea leaves to a certain degree. We heard from the Israeli defense minister. He spoke to troops last night. He said, very soon you will see Gaza from the inside. That is what we've heard. But again, we've heard an evolving story about what this ground offensive could look like. There are a lot of assumptions that this will be a full column that comes in, an occupation, but the Israelis have sort of talked down from this. And what's really interesting, Manus, is to think about what the U.S.'s involvement is in this and giving advice to Israel and cautioning Israel. We've heard a few of the public statements. They've been very couched. But from our reporting out of here in Israel, we understand from Israeli officials that the U.S. is very involved on this on two fronts. One, what form the ground invasion will take to ensure that it minimizes civilian casualties, but then also, Manus, the what comes next. The big question of what happens if Israel is successful in its aims, what will come behind it? The U.S. is certainly involved in those conversations.
Oliver, thank you so much. That is Bloomberg's Oliver Crook in Tel Aviv. All right, let's shift gears now. And Chair Powell hinted that the Fed is inclined to hold interest rates at its November meeting, but left open the possibility of a future hike.
Additional evidence of persistently above trend growth or that tightness in the labor market is no longer easing could put further progress on inflation at risk and could warrant further tightening of policy.
Let's bring in now Bloomberg's Jill Desis on this. Jill, we had a Chair Powell here that Stephen Stanley of Santander called willfully dovish. What should we make of this kind of whiplashy Fed speak from Powell?
Yeah, Danny, look, I actually think that at this point, all Powell is saying about the next meeting in November is that this surge in yields has kind of done the Fed's work for them, right? We can just put on a pause there. You don't have to expect that further increase in rates, at least for that November meeting. But I actually found his comments, quite hawkish in the long run, right? I mean, because we're talking about this idea that we've just gone through this historic tightening cycle. We've gone, pause, hike, and yet he's leaving open the door to future rate hikes. I think, Manus, I'm really glad that you brought up earlier this idea of taking the long view and investors really trying to understand what higher for longer actually means in this type of environment, because I think that that's really what this is turning to, this idea of going to 2024, the idea that we could still not just see higher rates, but even potentially, another hike, I think is really, really what we should be paying attention to here.
Well, I think what's even more interesting, when Stephen Major had a coffee with me when he came off surveillance, he said, what you've really got to grasp, Manus, is that this world was higher for longer in 2013. That was very, very clear. Here you are, 2023. It's actually higher for shorter, but we haven't really got our heads around that. Look, I mean, to the point, Powell maybe unintentionally gave investors a green light to keep selling bonds.
Yeah, I mean, Manus, look, he did point out that obviously the economy has been incredibly resilient. We have seen a bit of a drop-off, some cooling off in wage growth, certainly. But, I mean, you look at some of those economic indicators, and I think the point here, too, is that, for however many months ago we were talking about the possibility of recession, we're still dealing with an economy where inflation is not coming down, to that 2% target. We're still seeing a lot of those signs there. And, I mean, the fact that he's opening the door to saying, tighter monetary policy could be down the pike, I think that that's really what, again, people are paying attention to.
Yeah, Manus and I talked about it at the top of this show. Break-evens 10 years back at their March high. Jill, thank you so much for that wrap-up. Bloomberg's Jill Desis there. All right, now let's get you some other stories that are trending on the terminal this morning. Your top stories. The PBOC handed lenders a record sum of 733 billion yuan in hopes to iron out the swings in rates. The cash injection is the latest effort by China to get its economy back on track with lack of demand and the downturn in the property sector eating into growth. Now, belatedly, a default from distressed Chinese developer Country Garden is all but official. The developer has yet to pay its dollar interest after an extended grace period.
UBS is set to deliver the next wave of job cuts at Credit Suisse, targeting 10% of support staff. This according to reporting from Financial News. The latest downsizing is set to start on November the 6th. This as the company continues to restructure. According to the UBS CEO, Sergio Amotti, 8,000 Credit Suisse staff have left globally since the beginning of this year. Danny.
And in deal news, Merck has agreed to buy the rights to sell 3 experimental cancer drugs from Japanese drug maker Daiichi Sankyo as much as $22 billion. Daiichi rose as much as 18% on the news. That's its biggest intraday jump since 2005. Merck, for its part, is hoping to bolster its dominance in cancer treatments with one of Daiichi's drugs slated to seek U.S. approval in 2024, Manus.
Well, coming up in the show, we're going to discuss those Fed Chair Powell remarks in a little bit more depth. Andrew Brenner at NatAlliance Securities, known for a comment or two on markets. And we're going to speak to Nadia Martin-Wigan, director of Svelvand Capital, on the risks to the oil markets right here on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community. When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. It's clearly a tightening in financial conditions. Does it feel like policy is too tight right now? I would have to say no. If a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher. My guess is it'll be somewhere in the middle. The committee is proceeding carefully.
That was Fed Chair Powell speaking at the Economic Club of New York. And Manus, during that talk, we had some pretty significant movement on the curve.
We had. I mean, it was virtual whiplash. But of course, you and I have run the numbers this morning. We looked at the curve. The short end seemed to cling on to there's going to be a pause in November and didn't really listen to further rate hikes. The long end is living in fear and terror. And I want to show this chart as we go to Andrew Brenner. This is the curve. There was a massive steepening yesterday, 13 basis points, the biggest one day since March, Danny, and we're careering towards zero. So, Andrew Brenner, good morning, head of international fixed income, I should say, at NatAlliance Securities. The short end is hopeful. The long end lives in peril, I would say, of inflation, supply, and deficits. So are we at the start of, again, a much bigger second leg of steepening of the long end, or are we nearer an exhausted point? Good morning.
Good morning. Appreciate you having me on here today. What I do is I look at what the 2 year's been doing, and I think the 2 years is extremely well anchored. Just to point out that on September 20th, the last time the Fed that Powell spoke in the presser, the 2 years were 5.17 and the 10 years were 4.36. Now the 2 years 3 basis points better, and the 10 years 60 basis points worse. I think the Fed is done, and I disagree with your previous guest, Jill. I believe the Fed is done. As I look at the December numbers, as I look on WIRP, as I look at the January numbers, I think the Fed is absolutely done, and they're going to let the high real rates that have occurred in the last month do the work for them. So I don't expect the Fed to do anything more. The question is, when do you start buying long rates? And even though 5%, you didn't quite get there on 2s and 5s and 10s. Boy, they sure do look good to me. But I'm not going to be crazy enough with. Go ahead.
Andy, to that point, I mean, there is this risk if the front end is well anchored that the long end is unanchored. You look at some of the impact of that. For example, we have a chart, 30-year mortgage rates above 8% for the first time. Does Powell risk here not just letting the long end do the work, but actually losing grip, losing control, and therefore something breaks?
There's no question that breaking is certainly one of the biggest things on our mind. So that's why we continue to put clients in the short end between 1 and 2.5 years. That's where you really should be. But to your point, I look at the banking system, and when I see Bank of America's numbers, where they have 139 billion of losses in their hold-to-maturity portfolio, and I just wonder how many more banks are like that, and at what point will people start to panic about banks again? I mean, that's a large number. And even though Bank of America can handle it, there are many banks out there that can't. So yes, I believe something will break, which is why I don't think you're going to get significantly higher than 5% on 5s and 10s. Excuse me, 5s and 10s. But to the point yesterday, in the middle of Powell's speech, you saw at one point that the 30-year go from 498 to 510 in an instant. So there's very little liquidity out there. This morning, we're seeing better buying coming out of futures. And as you've already gone over the numbers, the Treasury market's, pretty much bull flattening a little bit this morning, but that's pretty much meaningless. Again, the biggest meaning thing is the 2-year anchored. I'm sorry, go ahead.
No. Listen, it plays to what Mohammed Al-Arian said in the FT the other day, which is some of the most, it's one of the most influential markets in the world, the bond market, and some of the anchors that they have, the long-term anchors, the short-term anchors. This is what he said in the FT. The most influential segment of the world's financial markets is losing longer-term strategic anchors and is at risk of its short-term stabilizers ones going as well. If you think about it, that's the Fed prevaricating. They don't know whether they're cutting or, the start of the year, cuts were coming. Now we're higher for longer. Deficits, no sign of a reduction in deficits. And the buyer, the absolute core buyer of bonds is gone. They are in QT. That is the Fed. How destabilized is the bond market?
The bond market, the longer part of the bond market is absolutely in trouble. There's fiscal dysfunction in D.C. I mean, I've never seen it worse. No House Speaker, and people just can't seem to get along. I mean, it's just a matter of time before Moody's takes away the AAA rating of U.S. Treasuries. As far as some of the other things, yeah, I'm worried about who is going to be the marginal buyer. The Fed is out, but you know what, man? If you look at the Fed numbers, that when 30 years mature, right, and old 30 years mature, they might be a week old or whatever. They're buying 30 years again. Same thing with 10 years.
Right.
So the actual duration of the Fed's holding is actually increasing, but that's minor. The biggest problem I have is where the bank's going to be, and can the banks step in and buy treasuries, and I don't think they can.
Okay.
Fair. Manus, one thing I have to say I've learned from this conversation just by looking at Andy is that cash is not trash. It's a fashion statement.
There you go. We gotta thank him. You can go back to bed now, Andy, and sort of relax. Danny and I, don't worry about us. We're just here for another 40 minutes driving the bus, changing the gears. But it's good to get you up and get you with us. And the done. There's the headline from Andrew Brenner at Nat Securities. Our guest this morning on the reaction to Chair Powell's speech right here on Bloomberg. Good morning.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that a small nation is forced to choose sides.
Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Welcome back to Bloomberg Brief. I'm Danny Berger in London with Manus Cranny in New York. Now, Manus, Bloomberg has reported this before, that we know UBS aimed to do a lot of job cuts, 30% with the combined unit. Well, Financial News is reporting early this morning that UBS is going to start that first wave. It's going to be about 10% of staff at Credit Suisse.
And that is probably going to be in those big functional areas of the bank, like compliance and legal. Hey, just some context for you, Danny. The two entities combined is 120,000 people, and the original guidance was a downsizing of around 30%. Or Modi, I think, last said, look, 3,000 jobs will be made redundant over the next couple of years. So it is a huge job to do with a lot of human cost.
Right. It might not be the last time we hear of job cuts to come. Speaking of job cuts, Manus, if you're looking for a new gig, it seems that some CEO roles are opening up. We have this data with exits from CEOs soaring by a record pace.
Yeah, the Great Resignation was supposed to be mere mortals, such as yourself and myself. I am mortal. But of course, if you look at this report, 350 of them are leaving government and non-profit jobs. That's because their pensions are full. The rest of us have got to slog it out. Right?
Must
mortals.
Be nice.
Mortals.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Welcome back to Bloomberg Brief. I'm Manus Crenny in New York.
And I'm Danny Berger in London. Here's what you need to know. Geopolitical risk rises on multiple fronts for the U.S., with the Pentagon reporting increased attacks on U.S. bases in the Middle East. President Biden appeals to Americans to support war efforts. Chair Powell signals a hold for the Fed's next meeting while leaving the door open for future rate hikes, citing that inflation is still too high. And UBS gears up for a fresh round of job cuts at Credit Suisse, targeting about 10% of staff. That's according to Financial News. Well, it was a weird and difficult day for stocks yesterday. A really choppy session to start, ending in pretty strong declines. A terrible day following both geopolitical risk being heightened and Chair Powell's remarks. So you're seeing that carry through the future session, down 0.25%. Bank of America says that positioning is so bad that their contrarian alarms are ringing. Maybe it's time for a short-term rally. European equities, those are also having a terrible day. They are trading at their lowest since January of this year. Basically, every sector is in the red. A lot of strategists questioning whether we'll really get a year-end rally for European equities. And man, it's just to put a bow on this of what a tough day is. No markets are being spared. Even China, which saw a record cash injection coming from the PBOC. Instead, it's still property stocks worries. Instead, we've seen a round trip. We're now lower from where we were when China first reopened. It's all of those, plus just overall really bad risk sentiment this morning.
Well, that risk is being driven ultimately by geopolitics and the Fed. And if you look at those multi-year highs, we're stepping back from that. Stocks are down, but also yields are down at the same time here behind me on the 10s. We're down ever so slightly, down by 5 basis points just 30 minutes ago. The short end of the curve is listening to the narrative of proceed carefully, but the long end of the curve is trapped. It's really trapped between higher inflation, perhaps a buyer's absence of buyers. We just heard from Andy Brenner there at NAT Alliance going, at around 5%, they are a screaming buy. The Fed is done. By the way, one of the biggest steepeners that we've seen in the market yesterday, the virulence at the longer end of the curve yesterday was really, really pervasive. We shot up by 30 basis points this week on the 10-year. The curve moved by 13 basis points higher. Let's see whether that steepening is done. Oil is up by 9% in the past 10 days. We go higher again this morning. So you've had 2 weeks of volatility and higher levels of oil. Again, this is due to escalation risk across the Middle East, Syria, Yemen, and Iraq. The U.S. at the same time seeks to perhaps fill up the SPR. What does that allow Saudi Arabia to do with their unilateral cuts? Perhaps the more robust hedge is gold, up $13 every day. The value, let's say, of the terror of war is approximately $13 in gold every day since the Hamas-Israel war began. We're up 2.4% on the week, and this is the second week of gains. Danny, good morning.
Good morning, Manus. It really is gold that's been the haven. It's interesting to look. We have bond buying this morning, but in general, TLT, for example, it's lower since Hamas first attacked Israel. It's not acting as that haven. And maybe this gets back to Andy Brenner's point at NAT Alliance that sure, 5% looks juicy, but he figures something is going to break. Do you really want to buy if that's the case?
But that's the second guest this week that has come on the show and said something will break and that will be the alpha for the bond yield to drop further. The question that goes through my mind is a roll down in yields of 5 basis points on 10-year paper. Is that duration hunters arriving, or is that really people who want to load up on bonds as a defense, even though the argument is the other kind of assets are perhaps a little bit better for you to consider, whether you want to have a flank and perhaps a hedge against escalation risk. Denny.
Well, oil is certainly doing that for you. And it's set for an additional boost, Manis. The U.S. is aiming to buy millions of barrels of crude for delivery, just as prices, as we've been talking about, have been lifted by the crisis in the Middle East. Joining us now to talk about this and all things oil and energy, it's Nadia Martin-Wiggin, director at Untitled Capital. Nadia, what do you make of the timing of this? The U.S. wants to buy in December or January. What does this do for an already tight and already fearful oil market?
I think the main point of that announcement is to tell Saudi Arabia that they're back in the market. This is the original price floor that Saudi Arabia and OPEC Plus have been trying to protect, is around $80. And the U.S. is finally saying, okay, at $79 a barrel, we're buying. So 2 weeks ago, before this war broke out in the Gaza Strip, we had the U.S., Israel, and Saudi Arabia talking about a deal, right? And as a part of that deal, Saudi Arabia would bring back more oil in January. So I think this announcement is about pushing Saudi Arabia to be open to do that for the U.S.
It'll be interesting then when we go to OPEC in just over a month's time, Nadia, to see whether Russia and Saudi Arabia do travel that road that you suggest. I think the last thing they want to do is let the taps open and undo some of their work. But that's the other side of the trade. You say, and we quote, that's why we ask you what you think. Ultimately, the oil market will adapt to the realities. If necessary, trade flows can be altered. SPR inventories can be tapped. And production in some countries can be raised, and some demand may be destroyed. Where is demand destruction? I mean, we haven't touched on that for a while, have we? We've talked a lot about $100 coming along, but I haven't heard anybody talk to me recently about demand destruction.
Yeah, and this is when we put it in that macroeconomic environment. The demand destruction argument has been coming since interest rates started, right? And that's where we've had this skew in the oil market to the downside. Now we're finally in the situation where the bad news is out on the demand side, and now we're really looking at the supply side shocks, which is creating this positive skew of things. I think where the demand destruction really happens is probably at around 110, 120, maybe even higher. And the key point is whether it's lasting, because what we saw with Russia's initial invasion of Ukraine in this war is things popped higher, but they didn't stay there, right? Because we reshuffled things. The difference is in natural gas, that is where we had the prices have to stay at such a high level to really destroy demand.
In some of the other reshuffling, Nadia, what will be the impact of more Venezuelan crude coming onto the market? Is this just, as some people have labeled it, a Band-Aid, or can it really do something to smooth out some of the volatility?
In our view, it's too little, too late. Really, the Biden administration needed to be working on this for the last year, because when the initial opening happened, since then, we've had 150,000 barrels per day of additional crude come out of Venezuela. But now there are infrastructure delays, and that means investments by oil companies to bring out more production. Within 6 to 12 months, we can absolutely get an additional 500,000 barrels per day. But who is going to trust the Biden administration when we have a U.S. election coming in November, when Biden might not be in charge anymore? And his track record hasn't been fantastic in terms of following through on what he says with oil producers, as we've seen in the shale patch.
What is bigger and more paramount in your mind? We started the show at 5. At 5:30, we talked about a 9% rally in the price of oil in the past 2 weeks. Are you looking at the geopolitics as a serious alpha for this market? Bloomberg has run the numbers. On a real escalation, they see $150. How do you think this market is positioned? Because the hedgies had slashed their positions going into this war. So what is the risk of $150 on real escalation? You're in the market. You tell the economics team what you think.
Yeah, I mean, it's very hard to be short this market now, right? So increasingly, I think there are more and more positions going to the upside, and that is what we absolutely saw last Friday. But are people all in? No, because right now we haven't lost a single barrel of oil yet, right? We haven't even lost any natural gas. So I think there is absolutely more positioning that can come. And this is where, where we see that temporary shock, it will be a very high price. But where we see that lasting, it might be $110 a barrel. It might be $120, $125 a barrel. It really depends on the macroeconomics. And this is where our view is that we're really in soft landing territory in the US. So the demand is slowly going to pick up and do okay. And we see record imports of oil in China. So China is doing super well in terms of oil. The only part that is lagging is on gasoline. That's where we see that travel is not that high, and that's in the US. And that's, of course, the first headline that everyone has been focusing on to put a bit of their shorts on. But this is where I think if things were to calm down now in the Middle East, we get a stalemate more like we saw with Russia and Ukraine, then the oil price will actually come down first.
So Nadia, then just to put a finer point on this, we only have less than a minute here, but what trade in this energy patch do you have conviction around that you're happy and confident to put on now, given a lot of cross currents we just walked through?
Well, it is definitely much better to be towards the upside, right? Call options, that sort of thing is the stronger element, because going into these weekends, things could really jump off right now. And then I think when we look on the general macro commodity space, being long other commodities like iron ore and things like that are also continuing to have a recovery, that is another good spot to put one's money.
Okay, Nadia, afraid we're going to have to leave it there. Thanks so much for joining us this morning. That is Nadia Martin-Wigan of Svelland Capital. Now, to that point, a quick check on these markets. You are looking at both Brent and WTI charging higher by 1%. $90 a barrel on WTI, 93 when it comes to Brent. Gold also moving on this too, trading at the highest since May as nat gas comes in. This is Bloomberg.
Connection lost.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm still running for Speaker, and I plan to go to the floor and get the votes and win this race.
That was Congressman Jim Jordan after emerging from a 4-hour meeting with Republicans. Kate Ackley is with Bloomberg Government. I mean, the latest. I mean, it makes British politics look positively calm, doesn't it? I mean, where are we with this, with Jordan? Another vote today?
Right. Jordan is going to have a press conference at 8 o'clock this morning. And then the plan is for a vote at 10 o'clock on his, bid to be speaker. It'd be the third vote. We don't see a lot of change in terms of, is he going to get, more support, less support? Probably it's going to be about the same. He had about 20 Republicans voted against him the last couple of rounds, more or less. We don't see that changing a lot. We're not seeing that, something is dramatically different. And basically, this has just paralyzed the U.S. House of Representatives. It's not, House Republicans do not have a governable majority.
And without that majority, without that functioning of government, Kate, what does it mean for sending money to Israel, to Ukraine, to help them fund what's happening there?
Yeah, that's a really good question. It can't happen without, an empowered Speaker of the House. And so the last 2.5 weeks that we've been in this kind of speaker crisis, if you will, one of those weeks was going to be a recess week. Congress wasn't going to be in town anyway. So now, though, with the president planning to send this budget request, we're talking about tens of billions of dollars, maybe $100 billion for funding for Ukraine, funding for Israel. If the House can't move, people are going to start to take notice. And this is going to be, a problem for House Republicans and a problem for the U.S. government overall. And I think, we also have noted repeatedly that in mid-November, U.S. government funding, will run out. That continuing resolution, that stopgap will run out. So that's when the U.S. government could have a shutdown.
So there's multiple crises coming down the pike, so to speak. What is the risk that Patrick McHenry, and this was one of the suggestions yesterday, that Jordan step back and they let McHenry step in until the start of the year to give him more time to get his ducks in a row. Is there a coalescing around McHenry? Is that a real possibility?
It looked like it yesterday. This is where yesterday was a kind of a whiplash. Patrick McHenry is going to be a temporary speaker with real authority. And even Jordan was said to have backed that. But then other people in House Republican leadership said, no. And there was sort of an outcry. No, we're not going to do that. So, that's off the table for now. But who knows? Again, you feel this whiplash of different ideas coming and going as they try to work through this.
Kate, thank you very much, as always, for getting up early for us this week. Kate Ackley of Bloomberg Government. Now, shifting over to China, the PBOC kept its 1-year and 5-year loan prime rates unchanged, but had a record cash injection in one of its shorter-term liquidity tools. Joining us now to discuss is Bloomberg Asia government and politics correspondent Rebecca Chung-Wilkins in Hong Kong. Rebecca, what kind of signal was the PBOC sending from this?
Yeah, as you say, LPR rates unchanged as expected, but what wasn't expected was that record amount of liquidity injected via that short-term monetary tool, and really sort of emphasizing its commitment to try and ensuring that there is enough cash and the costs remain low enough in financial markets to allow some of those tentative signs of growth that we've seen to really take hold. And it's also sort of anticipating this demand for cash as we head into tax season for China, which will be sort of another strain for some. We've already seen China cut benchmark rates and the reserve requirements for banks twice this year, and that has had some effect when we look at, for example, that third quarter GDP up 4.9%, slightly higher than economists had expected. But the prevailing concern, of course, is still property, and that is really sort of the big unknown.
Well, it's certainly one of the biggest unknowns, and it's what the government are battling against, isn't it, with all of the incremental policies. How much of a problem does the real estate crisis really pose, Rebecca?
Yeah, I think that's the critical question. I mean, Beijing hopes that we're now coming to the end of the crisis, but the reality is that we have Country Garden, once China's largest developer, on the verge of an official default. We have sort of investors planning for some kind of restructuring scenario already, and it is a huge firm in China, and it is significant symbolically too that we would see a firm of this sort of scale, and a firm that has actually, by comparison to, say, Evergrande, borrowed quite responsibly over the years. It didn't expand into sort of huge conglomerate, for example. And the scale is important. We see a lot of the projects in third and fourth tier cities, smaller cities in China, where consumer consumption is a bit slower to bounce back.
Well, if we're talking Evergrande, we got to talk about Country Garden too, because another day of, well, did they default? Did they default? But we just can't call it that. Where do we actually stand on Country Garden and potential restructuring to come? And quickly here, Rebecca.
Yeah, I think we are in a default, but all but name. I mean, I think in terms of investors' perspective here, we already had a statement from a company saying they don't expect to make all their offshore payments, and we're just waiting for that sort of final official tag. Investors at Country Garden already starting to prepare for a restructuring, and in fact, that is reflected in the bond price. We didn't have much of a movement, even as we came through the end of the grace period on the 17th, 18th October this week. So expectations is that we are going to see some kind of restructuring scenarios. Bad news for China, another huge complex restructuring on the horizon, just as Evergrande today, for example, has said it needs more time to reassess its own restructuring.
Okay, I look forward to the things that we missed. You got to go on Twitter and get Rebecca. It is literally, it is the upsum of the week. I have envy. I have Twitter envy, not Twitter envy, X envy. Rebecca, thank you very much. Rebecca Chung-Wilkins, I just destroyed a couple of $1 million worth of rebranding there. Let's talk about the shekel, because we have seen, again, some pretty tough moves, Danny. This is the dollar rising, the shekel falling. This is now the weakest since 2011, and the options markets show that they're getting even more bearish. We're going into the weekend where the risks are rising on multiple fronts of ground invasion, as well as the risks in Syria, Iraq, and of course those missiles that were down that came in over the past 24 hours by the US side.
Yeah, and man, as a quick look at your other currencies this morning, you do see some dollar strength coming through. Notable currencies, sterling having a tough go at it. Some UK retail sales data we had today slid, not great. And yen made another go at 150, but there's that huge options wall there that keeps beating it down for now. We're at 149.93. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisce with former and current players.
He's a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
I see a world where financial conditions have gotten tighter, and the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. So the real impact of higher costs around the globe, in the US and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical.
Nobody covers business like Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day with a look at what's ahead. We have a lot of earnings. We're going to get Schlumberger, Amex, Regional Financials, and Huntington. Those will all hit before the opening bell. Then President Biden will be hosting European Commission President Ursula von der Leyen and European Council President Charles Michel in Washington. And then it's been a really big week of Fed speak, and that's going to be wrapped up with Presidents Harker and Mester at 9 a.m. and 12:30 p.m. Eastern, respectively. And Manus, the voice from Powell has been the same as we've heard from others. I'm sure we'll hear from Harker, who tends to be dovish, is this proceed carefully narrative.
Yeah, I mean, the short end, I mean, what we are seeing is yields overall coming lower this morning, 10 years coming back from that near 5% level. The question you need to ask yourself as you go into the weekend is whether that drop in yield, Danny, is as a result of duration, brave duration heroes arriving, I don't know, or is it some form of hedge? There's a couple of micro movers we got to keep an eye on as well. I call them micro. I hardly call American Express micro. But they're going to give us their earnings before the bell. And then you got UAW and GM. They're inching towards a tentative deal. I mean, we've seen this before, the union negotiator says. But, I mean, that's going to be high on the agenda if there's breaking news over the weekend for GM. Danny.
Yeah, and Manus, to that point, I mean, it's one of these many shocks. We talk about a potential wage shock from some of the strike negotiations, supply shock, all those kinds of things had been pushing yields higher. But what we are seeing today across bonds is they are getting that bid. As you say, is it finally those brave enough to buy duration, at least for the U.S., or is it haven bids or something else?
Well, one thing for sure is you saw one of the biggest curve steepeners go through since March. This is what you and I looked at 3 a.m. this morning. 13 basis points, curve steepening. We're almost back at that zero. Does that continue? Because I would say the long end lives in peril and fear of a lack of assurity from the Fed on what they're going to do. It lives in fear of inflation. It lives in fear of supply. It lives in fear of deficits. I think there's a heck of a lot of fear that's driving the long end of the curve. But of course, we had Nat Alliance with us this morning, and Jim has a very different view. He's gone back to bed now, apparently.
Andy Brenner, look, can't blame him. Gone back to bed. After saying something will break, he just turns off the TV, turns off the camera, and goes to bed. I wish I could live with that kind of thing and not let it keep me up at night, Manus.
Living the dream, living the dream. The Fed's done. From New York. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
We are still very much in a late cycle economy.
I think the Fed keeps rate higher for longer until they get a recession.
High for long will still be an important part of the narrative.
We're going back to 2%. The Fed is absolutely capable of getting us there.
I think the worries are going to come for next year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's try and get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. What a week again in this bond market. Your 10-year, high of the session, 499.20. TK this week alone, up 33 basis points.
This week alone, history made. There's going to be a lot of study of this. I predict you're going to see it over the weekend. How do we go back? Where do we go back to? Maybe we go back to 1870. There was a real panic there. Maybe we go back to the Napoleonic War. But the summation of John 4 weeks of movement is history making.
Within 1 basis point of 5% on a 10-year a little bit earlier on. You need to look at the curve as well, just how things have evolved. The 2-year versus the 10-year, the shape of the yield curve, that was negative 110 basis points earlier this spring. Bramo yesterday, a break of 20.
That, to me, was what I looked at, this fact that it's really kind of moved in the opposite direction of what people thought. They thought the long end earlier this year would move down to where the front end was, or the front end would actually move down to where the long end was, and you would get a flatter, lower curve. It has been the opposite, and yesterday Fed Chair Jay Powell said, it doesn't seem to be inflation. It's something else. And it doesn't seem like we're overly restrictive, but there seems to be a fear that is not really within their control.
So what do you do? Drum roll, you proceed carefully into November. So November's no longer a live meeting, correct?
That's sort of what people are pricing into the market, but still there is a chance of another rate hike this year. I don't know whether that matters. I think it's telling that the long end still sold off. You saw yields go higher after that speech. Tells me something.
Policy is not too tight. Is that the right quote from Chairman Powell, David Westin? Policy is not too tight.
Yeah, well, it's getting restrictive, and the answer is on the Bloomberg. We actually look at the numbers to 3 decimal points. Not the data check, John, but there we are off of Powell. We are restricted. The Bloomberg Financial Conditions Index, Goldman Sachs with a nice index too, negative 0.2. We have moved from accommodative into some form of statistical restriction.
And this equity market struggled this week, to be clear. Equities poised to snap a 2-week winning streak on the S&P 500, right now negative by 0.2%. Let's whip through the price action together. Crude heading towards a second week of gains, back into the 90s. WTI, $90.70. WTI crude, Bramo, up by 1.45%.
So we get the last day of Fed speak before the quiet period today. The last gasp. Fed speakers today include Philadelphia Fed President Patrick Harker at 9 a.m. and Cleveland Fed President Loretta Mester at 12:15 p.m. I'm curious if they reiterate this idea that it's clear that perhaps we're not overly restrictive, but also that they're seeing wage gains really wane. And that was something else that I thought was interesting from Jay Powell yesterday. At 12 p.m., this is going to be potentially contentious. President Biden is meeting with European Council President Charles Michel and European Commission President Ursula von der Leyen. It is the second U.S.-EU summit since President Biden took office. But this comes at a time of incredible divisions, even within these two stalwart allies, particularly around steel. And I'm just curious how that dovetails into some of the war conversations. And today, in terms of earnings, I'm actually more interested in the regional bank earnings right now, John, than I am in some of the big banks. And we hear from some of the bigger names that have had trouble. Bank of California, which acquired PacWest, Aftermarket, Western Alliance. We deal with Comerica, Huntington, and a whole host of others. To me, does this give a clearer read in the pain you've seen in regional banks on the U.S. economy than anything that we saw to the bigger banks?
I totally agree with that. I think I've never said what you just said before. You're right. The answer is this is a huge, huge deal. And what's really interesting to me is not now, but I want to go out 3 months. What is it, the first week of February, whatever?
Sure.
That's going to be sport.
I'm totally with Lisa. This week, what was the lesson? Bank of America is not the Bank of America, correct? Based on what we heard from Brian Moynihan.
Well said. They do not cater to the average American. They also are not necessarily leveraged to the same kind of pressures. And oh yeah, they basically have free money that they can then use for other things. They might have parked it in treasuries, which is a problem, but that's not a luxury that a lot of these regionals have.
Busy morning going into the weekend. Your equity market negative 0.2%. We begin with our top story. The president addressing the nation.
I know these conflicts can seem far away. And it's natural to ask, why does this matter to America? Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
A rare 15-minute Oval Office address setting the stage for a formal request that Congress provide $100 billion in resources. The team coverage starts right now with Bloomberg's Ollie Crook in Tel Aviv. Morning, Ollie.
Yeah, John, that's right. And that is sort of the big news here in Israel as well, that request from Biden. We understand more than $100 billion, but most of it going to Ukraine. So I think the question for Israelis will be the question for Biden today, which can you get this through Congress? We understand that $60 billion of it is for Ukraine, $14 billion for Israelis and Israeli defense, and then $10 billion for the humanitarian aid. And again, we heard from Biden again in the speech last night, as we heard from him in Tel Aviv, cautioning Israel about how they proceed in this, mentioning 9/11, but also speaking about the Palestinians, saying that just because Hamas has held this attack, it does not forfeit the right that the Palestinians have to live freely and to live without danger. That being said, 14 days into this, the aid has still not crossed.
Oliver, I am absolutely thunderstruck on a Friday by the lack of military discussion. We talked to a Screaming Eagle yesterday of the 101st Airborne. We talked to a Marine of Fallujah. What are the military people telling you, the media in Tel Aviv?
Well, let's have that discussion now. The mood music, we should say, on the Friday is also a day that Hamas has called for another day of rage across the Islamic world, which last week when we saw thousands took to the streets. Overnight, we've had more strikes in Gaza, more strikes in Lebanon, and we've had the Israelis evacuate more people from the Lebanese border. The United States also intercepting cruise missiles and drones, we understand, fired from Yemen towards Israel. There is the small matter of a huge country that sits between Yemen and Israel, and that is Saudi Arabia, which is where our attention turns also to the weekend, where we understand there will be a peace summit held in Cairo. The details are still fluid and sketchy, but we understand from our reporting that Mohammed bin Salman, the Crown Prince of Saudi Arabia, will be in attendance. So too the President of Turkey and representatives from the EU Foreign Ministry as well. Again, maybe a second crack at the diplomacy that failed earlier in the week with Biden.
Based on the fact that there have been all of these diplomatic talks, do we have a better understanding of why there has not been some sort of ground invasion, about whether there is a feeling within Israel trying to perhaps have some restraint to not flame some of these fires?
So I think this is a very difficult question to answer, but I think that Bloomberg has done some very interesting reporting on this overnight. So again, reading the tea leaves, what have we heard from the Israelis? Yesterday, the defense minister, he spoke to his troops. He said that very soon you will see what Gaza looks like from the inside. That's what we heard from them. However, as we know, the rhetoric around what this military incursion will take has shifted. And the question is, how much influence has the United States had in terms of shaping that and potentially delaying it? In our reporting, according to Israeli officials, we understand that the U.S. is much more involved in these kinds of discussions with the Israelis than it ever has been in the past, with an interest, one, in reducing civilian casualties to the maximum point, but also in the question of what next. The after Hamas conversation, the United States is still very much in that conversation.
Ollie, great work as always, buddy. We'll catch up with you a little bit later this morning. Every single morning this week, we've had two objectives: to try and work out the potential for a broader conflict in the region, one, and two, to try and get an update on the humanitarian crisis that is very quickly materializing. The US and Europe are still pushing to open humanitarian aid into the territory, and yet, what do we see, Bramo? The Rafah border crossing between Egypt and Gaza, based on what Ollie just said, still closed.
It was supposed to be open this morning. There was supposedly an agreement that had to do with UN officials going through the trucks and making sure that everything was okay on everybody's sides. What's the holdup? We don't understand who is actually the main obstacle at this point.
That's one. And two, Tom, the military escalation, the prospect for it. The US saying that military bases in Iraq and Syria increasingly under attack.
We're going to talk to Professor Schiller here about this. She's the expert, but to me, it's the first war by cable TV. And the answer is everybody with diplomacy, with humanitarian aid, is getting out front of a war that is believed to come as soon as this weekend. I mean, we don't know, but it is the oddest of oddest sequence of discussions.
Let's get to Wendy Schiller, the director of European American politics, and policy director at Brown University. Wendy, wonderful to catch up with you as always. Just talk to me here about the President of the United States and whether he can keep his party together.
Well, I mean, I think he made a strong effort last night. I think he was a low-key speech, but he was coherent. I mean, he just got off a plane, a really long journey to Israel and back. And he basically reverted to a lot of the themes that we've seen from other presidents when there's conflict. You know, America stands for particular things, particular principles, and we also have experience with a direct terrorist attack. And we also, as he said, we made some mistakes. I thought that was one of the most pointed lines in the speech last night. You know, we got really as angry as you are after 9/11. We went in, but we made mistakes, and we urge you not to make the same mistakes. It was an interesting sort of world caution on the part of Biden to Israel in a speech that was supposed to be to the American voters.
Wendy, you're too young for this, but we were weaned on Greg Peck in 12 O'Clock High. We are so removed from any framework we have of war with this cable TV war. You've got huge perspective on this. How do we handle a cable TV war of immediate news, immediate headlines, immediate imagery?
Well, you know, for those of us who are old enough to even remember the first Gulf War, that was not very long, but it was also the first one that was visual, that was televised live all the time. And we do feel removed from this conflict to a certain extent in America. But of course, the concern is any sort of on-site or domestic terrorism that comes from any support of Israel or, you know, too many civilian deaths in Gaza. This is going to hit home. This will hit the American people in some way, shape, or form. And I think President Biden is trying to prepare the American people for the idea that we have to stick with our allies, and we don't want them to make the same mistakes. But this has made the world more dangerous. And we have to be on higher alert, not only in Israel, but of course in Ukraine and Taiwan.
Wendy, how difficult is it for President Biden that a big faction of his party, and a very vocal faction, I should say, has been pretty against him and pretty vocal in protesting some of his measures, in particular the squad I'm thinking of in the House?
This is, Lisa, to me, a purely regional concern in the state of Michigan, most of all as a swing state in 2024. We have a large Arab American population, a large Palestinian population. Of course, Rashida Tlaib, the congresswoman from that area, who's Palestinian. And that's a state he needs to win, and he needs turnout. And he can't have the party breaking with him, even with a popular incumbent Democratic governor in Michigan. So a year from now, this is a real problem for him. So he's really got to tread carefully. And if the civilian death count in Gaza goes really sky high, I think it does create a problem for him for the 24 election. But remember, this is almost an 81-year-old man who's been through a lot. and he is president of the United States, and he is doing what he thinks needs to be done today and tomorrow and the next day. He's unusual. He's not like any other president looking ahead to re-election concerns. He really is somebody who is trying to deal with the crises at hand today. And that makes him hard to predict because it's just not a playbook we've seen before.
Wendy, kind of shocking. Just to pick up on Congresswoman Tlaib, I checked last night her Twitter account again. The tweet is still up, blaming Israel for the blast of the hospital earlier this week. What do you make of that?
Well, John, that's also Tom's point about the speed of news, right? And the sort of everyone said, you know, it was Israel, 500 people died. We're learning now that it's most likely not having come from Israel, not an airstrike, and maybe the death count is lower, but it's still a horrific death count. And she's going to continue to do this. And, you know, this creates domestic problems within the Democratic Party. Obviously, the Republicans and the Jewish community have been pretty aligned in a lot of ways. Republicans have always expressed strong support for Israel. Now with the House in disarray, no speaker, and unable to pass this aid package for Israel, the Democrats have an opportunity to regain some of their momentum with the Jewish community that had been more supportive of Republicans. You know, these tweets and this particular congresswoman may throw a wrench in that kind of effort.
Wendy Schiller of Brown University. Wendy, thank you for the update. TK, that tweet is still up. The President of the United States has come out and said his own Defense Department has confirmed to him that they have evidence that that blast, the responsible party for that blast, was not Israel. And yet a tweet is still up from a sitting congresswoman in the United States blaming Israel, an ally of America. Make sense of that for me.
You're going to always have this, and what's so important here to understand is the scope and scale of the size of her audience. It is, to borrow a scientific phrase, teens weeds. It is, if you look at Pew Research in New Jersey, it's a little audience.
Coming up in the next hour, Alex Brazier of BlackRock on this market. Equities right now negative 0.3% from New York. This is Bloomberg.
The top names in business are on Bloomberg.
The market is starting to look over the Fed's moves into falling interest rates.
We actually think that core inflation is going to fall a little faster than the Fed expects, and that will allow them to start cutting rates by March of next year.
You get a price spiral when labor markets are tight, and manufacturing labor markets are still very tight right now in the US.
Nobody covers business like Bloomberg. Context changes everything.
You've seen the rates moving up and down a lot. I think we have to let this play out and watch it. It's clearly a tightening in financial conditions. Does it feel like policy is too tight right now? I would have to say no. If a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher. My guess is it'll be somewhere in the middle. The committee is proceeding carefully.
That message on repeat from the chairman of the Federal Reserve, Jerome Powell. We are proceeding carefully. From New York City this morning, good morning. Your equity market proceeding carefully, lower, negative 1/3 of 1% on the S&P. Yields lower by 4 basis points. Tom, your 10-year 494.56.
It's about the bond market, John. You mentioned this before we went live, and you look at equities, bonds, currencies, commodities. There'll be a lot of analysis. Oil popping. We'll talk about that later. Brent crude, if my eyes are not failing me, popping through to a 93 level, really back to where it was, John, in the shock of this war. But it's all the bond market in every single way we can analyze. It's what Bloomberg does best, and we can analyze it into next week, up, down, and sideways, losses.
Up, and away on a 10-year this week, up 30 basis points or so, but I'm with you on the losses. For some of the long bonds, Tom, that were issued a couple of years ago, we are talking about losses of something like 50%. And in some cases, in some jurisdictions, countries, more than that.
Lisa, what did spreads do yesterday?
Well, what you can see in the spread market has just been completely resilient, even with this fear.
Give me a why.
Because companies are in a better shape than the U.S. government. Yesterday, you did see spreads marginally higher, but still subdued based on where people would have thought defaults were.
I looked at high yield spreads, one of the fancies. You know what the symbol is, John, on Bloomberg?
Yeah.
BRAMO index, Bramo index. I looked at it.
I thought it was LF9808S.
It hasn't moved.
That's what it actually is.
That's what it is, right?
So if you actually try to do that, you're going to not get any spreads.
I don't know. Maybe that ticker works. I don't know.
Definitely does not.
But the answer is I was shocked. High yield really hasn't moved out.
Yeah, you're seeing a little bit marginally, but this has been the story. Corporations are in a better shape than the U.S. government.
We're going to look to Israel and the Eastern Mediterranean, but also pay attention to the markets. A Friday brief for you to pick up the pieces of your portfolio. Brian Levitt joins now, global market strategist at Invesco. Brian, I got 8 ways to go in the bond market. I blew up twice yesterday over fancy Frank Fabozzi rationalization. Look at price and tell me what the damage is that's been wrought.
Yeah, it's been a challenge. I mean, this was supposed to be a year in which the bond market was going to be better than it had been last year. Last year was one of the worst years we had seen in the bond market. And quite frankly, I think the big concern coming into the year was inflation expectations, and those have moderated. It's really been a real growth story. So the question going forward, just how strong is this economy? Does it warrant yields above 5%? I still believe we're likely to see the lagged effects of policy tightening and a growth slowdown, which would suggest to me the 10-year rate stabling and starting to come lower. But that's been a bad trade, certainly over the last few weeks, if not more.
Invesco has a rich portfolio of different types of fixed income, including loans and leveraged loans. Are there shadows out there that Invesco sees? Things like leverage in fixed income that we can't observe, but you know it's there?
Actually, the fundamentals in the corporate bond market are quite reasonable to the conversation you were just having. I just tried the Bramo function on the Bloomberg terminal. That didn't work. Yeah, it failed. But yeah, the fundamentals, as Lisa was suggesting, are quite good. And you look at corporate debt to profitability, we're not at troublesome levels. And to Lisa's point, the CFOs were paying attention. They were terming out the loans and generally at lower borrowing costs. So it doesn't seem to be a fundamental issue in the credit markets. What it is a reset in yields that's driving valuations lower in the equity market.
So where's the haven? And we've been asking this all week, Brian, but at a certain point, do assets traditionally thought of as risky serve as better havens than the risk-free rate, the risk-free securities of U.S. government debt?
I don't know that we're going to have fundamental challenges with the full faith and credit of the U.S. government. There's clearly a reset right now with regards to what will growth be. But ultimately, I think that the long end will start to moderate. You saw the beige book this week. There's some other mixed factors where economic growth looks a little bit more positive. But ultimately, I would expect the long rate to come in as the economy moderates here. But what a lot of investors are doing right now is they're hiding out in money markets, which I thought wouldn't be the best idea here. I mean, it is nice to get 5.5%. Without doing much of anything, but you have reinvestment risk. And so far that reinvestment risk hasn't hit. You've been happy with any type of reset 30 days later at a higher yield. But at some point, if the Federal Reserve has to ease, which is what the market expects by the middle of next year, then you would want to go further out in maturity, or you would want to look to those corporate bonds where the fundamentals are quite good, and even municipal bonds. I don't think enough are paying attention to the fundamental strength of the municipal bond market after all of the support from the federal government following the pandemic.
Are you starting to see signs that we've reached that pivot point where people are starting to actually think about reinvestment risk in a way that they haven't really had to earlier this year? This week, we actually saw some outflows from money market accounts, and we saw inflows into U.S. government bond funds. Do you see this as a sort of tipping point?
I think we should be nearing that inflection point. I mean, it's hard to say based just on a week of data, but in speaking to investors, what I'm hearing, particularly from the financial advisor community, is that they would like some ammunition to help their clients to move off of money market. They intuitively understand that historically, when you have an inverted yield curve, whether that was 2000, 2006, you're better off going further out. But it's a hard thing to explain right now to the individual investor who maybe had their money in bank deposits and just wants to capture a short-term 5%.
Let's ask a Legion question then. You have new cash to deploy. Do you buy bonds torn apart, torn asunder, or do you buy equities?
Well, it depends what you're looking to accomplish. I would buy equities. I think that they're going to move directionally in the same way. You start to see the weaker economic data or more moderate economic data, then you're likely to see the peak rate environment emerge. And typically, Tom, when we look out in an environment where we've already had peak inflation, you get peak rates, peak tightening. Historically, that creates a nice place for both stocks and bonds over the next couple of years, but certainly equity outperformance over the next couple of years.
Hey, Brian, good to get your view as always. Brian Levitt there with Invesco on equities, on bonds, looking out to next year. Barry Bannister of Stifel, caught up with him earlier this week. He's looking for a slowdown. Guess when? Back end of 2024. Back end of next year.
Well,
that's what he's looking for.
Some people are looking for that. Ed Hyman, through Julian Emanuel, reaffirmed his recession call for 2024. And, I don't really know what to make of it in a jumble of going into this weekend. My head's frankly spinning. I just looked at one of the major bond funds out there. This is a Vanguard product. Everybody's grandmother owns it. And the drawdown from not the beginning of the year, but let's say the first week of February, you're solid -8% on price. Now, you've made some income along the way, but I'm sorry, you're opening the envelope. John Tucker opens a 201k.
How's that
and he looks at the damage. And I mean, on a retail account, you're getting hammered.
They're going to see the damage in bonds, without a doubt. We're trying to work out what corporate America is telling us right now about the U.S. economy. And we're getting conflicting information. You look at the banks. Bank of America is talking about a consumer slowdown. JP Morgan's raising guidance. Look at the latest on consumer discretionary spending. LVMH, the airlines, are saying we've seen the post-pandemic boom. You look to Netflix, they're hiking prices. Lisa Tesla, they're cutting prices. Make sense of it all.
Nope, not going to do it. Sorry.
Difficult, right?
Well, this is the issue, is that there are all of these different cycles that are playing out, these sort of micro cycles, and putting it together has been uniquely challenging. What I do see is that economists surveyed by Bloomberg, there was a monthly survey that came out overnight, and it showed that economists are boosting their growth expectations. They are reducing the chance of recession, which is no longer a base case. They are talking about an annualized 3.5% rate of GDP growth in the U.S. for the third quarter, which would be the fastest in 2 years. We're talking about accelerating kinds of growth.
Exactly. Well, some people are talking a 5 handle on that 3.5%. I'm with you, but others, adults, are talking 5%.
Neil Dutzer is talking about some big numbers. It has been for a while. I've called it the 3-month rolling recession call. That's the year so far. It's been a 3-month rolling recession call.
Now it's 6 months.
Now it's 6 months.
Maybe 9.
Maybe 9.
Yeah, it's just too much.
It continues.
So we got a 2 and 20 payout on the triple leveraged all cash.
How's that working out?
It's great.
You had a good year.
For the first time in quarters, we've got a payout to the general partner.
Equities down 1/3 of 1% on the S&P from New York. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Heading towards a week of losses on the S&P 500. Equity futures shaping up as follows on the S&P. On the Nasdaq, we're negative 1/3% on the S&P. On the Nasdaq 100, we're down 0.4%. The Nasdaq negative for a third straight session yesterday. Bramo, will it be day 4?
And how much is this tied to yields and how much is this due to fundamentals? Right now, if Netflix is representative, it seems like the fundamentals are pretty good. So you have to wonder, are people getting nervous about 2.5% on the real yields in the U.S.?
Not at the moment. Brian Levitt of Invesco is talking about playing the recovery to the recession we've not had yet.
He's not alone.
Did you notice that in the last 10 minutes?
Yes, I did. Yeah, you know, I got upset twice yesterday. I was rude, but
What
I
were you
just,
upset
I've
about?
had it. I've had it. Seriously.
Okay, serious.
We've
Let's
never
go.
seen this, and we have they have narratives that are about rationalizing the Great Moderation. The available evidence, the Great Moderation is over, even though Chairman Powell spoke against that yesterday.
I personally cut people some slack because they come on the show and try to come up with a narrative, and then they have a sort of range of probabilities in their models to try to, play them out. I mean, this is my sense, and it's a very difficult moment to try to come up with a narrative when it's flipping and flopping every single day, and when you're not going to be right, period, full stop, because even if you get the narrative right, you're going to get the market wrong. So this is a really tough market.
That's what Tom would always say. I'm going to cut him some slack.
People need to adapt and adjust.
She's becoming sensitive.
Corporate America adapts and adjusts. Let me just tell you.
You're feeling kind today.
That's new.
I'm feeling a little bit frustrated trying to put narrative to some of these price moves that are just not understood.
It's difficult to ascribe a narrative to what's taking place in the bond market, but we'll try. 2-year, 10-year, 30-year. Looks like this. This week, cycle highs across the curve. 2-year, briefly, through 520. We're back to about 515.68. 30-year, 3.5%. 10-year, get in there. Earlier in the session, really, really close. 499.20, Tom, on a 10-year. Right now, 494.35.
First thing I looked at the real yield, 2.46%. Do you believe we had a 250 yesterday and all the hoopla, particularly with a missile attack from Yemen? I mean, it's just
aggressive
250.
Bear steepener.
Never, ever have I framed 250 real yield.
Amazing, amazing. Let's finish on crude. Second week of gains. WTI, Brent, have a sneak peek of things right now. Up by a little more than 1%. Back in the 90s. On WTI crude, getting back towards 94, Tom, on Brent, 93.54.
Did a moving average study of when it was well over 100, about $111 a barrel is what I'm going to, it's an approximation. That's a Friday guesstimate. 111 is that feeling of higher oil prices we had a number of years ago.
That's the latest in the price action. Under surveillance this morning, Israel striking targets in both Gaza and Lebanon as the Israel-Hamas war continues. This coming as a U.S. destroyer intercepted cruise missiles fired towards Israel from Yemen. In his address last night, President Biden making the case for more funding for Israel and Ukraine's war efforts.
I know these conflicts can seem far away, and it's natural to ask, why does this matter to America? Hamas and Putin represent different threats, but they share this in common. They both want to completely annihilate a neighboring democracy, completely annihilate it.
A rare 15-minute address in the Oval Office. TK, the president is about to make the case to Congress to deliver $100 billion in resources to support I believe, Ukraine, Russia, the southern border, and Taiwan as well, right?
I believe it's all
four issues, all thrown into one
The
top.
political, to get everybody's vote about what they care about. But I'm fascinated. We've got a congresswoman coming up here from the Midwest today. I'm really interested in the emotion this weekend, particularly with the news yesterday. It's their war. Mr. Biden's trying to say it's everyone's war. It's our war. The Europeans are the same message. I think there's a lot of people out there saying, wait a minute, is this our war? That's open to debate.
Well, it's become our war when you talk about the attacks on the Iraqi U.S. Army base, as well as the one in Syria. And you see the U.S. warships in the Mediterranean actually engage in terms of shooting down certain missiles. So there is a question of, yes, the U.S. is already involved. What should that role be? My bigger question here is actually about Saudi Arabia, because they're suddenly becoming a much more active player, meeting with the head of UAE for the first time in a very long time. How much has it become Saudi Arabia versus Iran in a sort of covert way without angering some of the population?
And not to do civics 101 or geography 101, but missiles from Yemen is something that Riyadh pays attention to. Doesn't really matter where those missiles are going. That's something to the north of Yemen they really pay attention to.
That's the latest abroad. Let's get to the dysfunction at home. Congressman Jim Jordan continuing his bid for House Speaker after previously saying he would support a plan to temporarily expand the powers of Congressman Patrick McHenry, the interim Speaker, after a 4-hour closed-door meeting. House Republicans, Jordan saying this: I'm still running for Speaker. I plan to go to the floor and get the vote and win this race. Jordan holding a news conference at 8 a.m. this morning. Bramo is going to sit tight and stay tuned to that in about 90 minutes' time.
Well, this is going to be fun. He's probably not going to get any votes that he got in terms of the first time around, anything close to that. He's losing votes as this goes on. There is increasing, hardening kinds of tensions within the party. There's certain intimidation tactics going on. There's a larger question pairing the whole question about Biden and his speech yesterday with this confusion. He's not going to get anyone to pass the $100 billion. They can't even bring it to the floor. So how does he sort of play this?
AMH in the next hour is going to tell you how. Looking forward to that. The cuts to Credit Suisse, they continue. The UBS is preparing for the latest. This coming from Financial News. The Swiss bank saying around 10% of support staff in areas including compliance, risk and marketing will be impacted. CEO Sergio Ermotti previously saying about 3,000 jobs will be, quote, made redundant over the next years as it completes its takeover of the bank. It's still working through what could be a really, really messy fallout for this combination.
How do they keep people without really emboldening them with some kind of morale boost, given these rounds of cuts and this feeling that this is going to be dragged out for a while? It's a very difficult moment.
I'm going to go to a separate story, which is linked directly to it, John. As Jack Sider's writing for Bloomberg about the flagship Credit Suisse real estate fund, global fund, big, fancy, people jetting around the world, buying towers and all that. It's marked down 9%. And as I said, the news now that we're talking on surveillance is next quarter's accounting. So if Credit Suisse is marking it down 9% in third quarter, as global property correction accelerates, where do we accelerate into January of next year?
That word global is important.
Yeah.
Not just America. Some pain elsewhere.
Well, I'll put it out on Twitter. Jack Sider's writing that up this morning.
Joining us now, Eric Nelson, macro strategist.
I was down looking at the Jack
at Wells Fargo. Don't worry about it. We'll get to the next guest, Tom. Let's talk about markets, Eric. We're going to proceed carefully. Is November a dead meeting?
I think so, John. It's priced at maybe 2 or 3 basis points at this point. And the Fed has made it pretty clear they want to be patient. Powell wants to be careful. I think it's going to take, even in December, a lot to move the Fed off the sidelines at this point. The message from Chair Powell yesterday was, we want to see continued evidence of above-trend growth. That's a key sort of precondition for more tightening. That means at least 1, if not 2 more, above 200,000 NFP reports. I'm not sure we're going to get that.
Eric, I got yens for 150. I know it's a side story, but I'm sorry, it's not a side story. On dollar yen, help us get through the weekend on this. If we get a 150 print, is that a trigger for Japanese institutional action?
Historically, Tom, it's been about both levels and volatility. So breaking 150 and accelerating, hitting 151, 152 in a short space of time, that has brought the BOJ in the past. I think last time, back in early October, it was probably more of rate checking, less intervention. So they've clearly made a line in the sand here. They're worried about this level, but I think you do need to see some more vol after 150.
The reason I bring it up because of the Credit Suisse story, and that all of a sudden, can I say, Japan is affected by Eastern Mediterranean events. Japan is affected by a global bond market rout.
Yeah, and there's a little bit of sort of circularity here, right, Tom? To the extent that the BOJ will tend to, or rather the Ministry of Finance will tend to offload treasuries in order to fund this intervention, you do have this sort of circularity, which is a problem both for the bond market and for dollar yen, right?
Right now, Eric, there seems to be a question about how much the market is actually appreciating some of the events transpiring in the Middle East, the conflict. And there have been a number of big investors that have come out and said that the market is really underpricing the risk of an escalation that's percolating in certain corners. What's your view?
Well, I think it's a question of timing, right, Lisa? I mean, we went into last weekend worried about ground invasion. That didn't necessarily occur as quickly as thought. Seems like maybe this weekend is a little bit more likely. But I think the question here is, you know, what is the scope of conflict that needs to really bring this to the fore for the market? I think it was interesting that Fed Chair Powell actually mentioned this in his speech yesterday. He said geopolitics was a downside risk. Haven't heard that in quite a while. You know, back in 2022, Ukraine-Russia was two-way risk. It was inflation to the upside, growth to the downside. So I think that, you know, that's maybe one reason why you haven't seen, you know, a further sell-off in the front end on the back of those comments yesterday. The Fed's clearly being cautious here.
So from your vantage point, what are you looking for to understand when it escalates to a level that people have to price in a little bit more aggressively?
Well, I think you certainly need to see, you know, other, you know, large actors being brought into. So I think that the big question for a lot of people is, you know, to what extent and at what point is Iran drawn into this? That's certainly a big focus. You know, I'm not going to make a call on that, but I think that's probably a big trigger. You know, outside of that, I think, you know, focusing back on the fundamentals and sort of what's driving the bond market here is, you know, to what extent is there going to be an impact on growth? Because that's really been the big, I think, factor here driving this sell-off in the bond market. And until that changes, either domestically or globally, it's hard to see a sustained rally here.
The Fed wants a slowdown. Bottom line. I imagine this Federal Reserve is actually quite nervous, Bramo. Nervous about the fact that the data is still pretty decent, going into the fourth quarter with the prospect of maybe that data continue to improve. And Lisa, ultimately, reluctant to re-engage with the hiking cycle. Because, Bramo, can you imagine what they'd have to do? They hike again in December and people start to think that maybe they're not done and we go into 2024. Priya Misra was talking about this over at JP Morgan with me yesterday. Just imagine we have to restart the cycle. And I don't mean just one more hike. I mean, like, they have to go further because the data keeps surprising to the upside. So when they say wait, what I believe it means is, please, between now and December, show us a slowdown in this economy, because they have got a massive problem in December if they don't see one.
Especially because, to Mohamed El-Erian's point, I know you're catching up with him today, the stop-start type of rate hikes is that much more damaging to a market that's trying to get a sense of linearity. And that, to me, is the bigger risk for them than the slowdown that they're hoping, to your point, will come.
It's October 20th at 10 a.m. this morning. We'll be holding a meeting for 20 people. It'll be on the 14th floor.
We'll
be looking at penciling out our outlook for 2024.
That's happening
Can you
right
imagine
now.
those
I'm telling you,
meetings?
that's happening right now. I always say about the year ahead outlooks, they're written in October, they're published in December, you sit there in January and you rewrite them in March. That's kind of how it works.
But I'm going to cut them slack here because they're coming off a medical event, the pandemic, and maybe we guessed wrong, and history will tell us we guessed wrong those tales from the pandemic, including the fiscal stimulus. But all we can say for certain is the majority of people, including Tom Keene, have been wrong this year. That's all there is to it. It's October, and we're supposed to recalibrate.
Let's get a final one into Eric Nelson of Wells Fargo. Eric, how reluctant will they be? Will they be dragged into this kicking and screaming